hold either for my type of strategy, 1 to 5 years, or maybe long term. My type of portfolio philosophy as far as adding shares and kind of getting around position is, in my opinion, you know, as an investor in the market, you should probably hold between 4 and 9 stocks, in my opinion. 4 and 9 stocks is kind of my perfect range as far as, and I don't care if you've got, you know, $1,000 in the market. I don't care if you've got, you know, $1 million in the market. This is my personal philosophy. 4 to 9 stocks is my perfect balance there. It's not under diversified as far as if you're in only, let's say you're in 1 stock or 2 stocks. Obviously, if just one of those stocks goes down dramatically, you know, goes down 20, 30, 40, 50%, you're going to be destroyed. Your account's going to be absolutely destroyed. Now, on the flip side, if you have, let's say you got 30 stocks in your account, let's say you got 30 stocks here, right? The issue with this is, how are you going to like stock number 27 anywhere even close to as much as stock number 7? Stock number 7, you know, that's a stock you're probably like kind of confident in. You know, this is even when you get to stock 7, 8, 9, these even are companies that you're like, man, I kind of believe in this one, but do I really believe in it that much? When you get to 27 stocks, at this point in time, you start getting into companies that you don't really believe in at all. Like if you had to put in my opinion, when you go to think about making an investment, you should always think like, if I had all my money in this one stock, would I be okay with that? Would I be okay if all my money? In my opinion, it's impossible to. You are not judging stocks hard enough if you have found 27 stocks that you feel comfortable having all your money in, or even a portion of your money. And the way you kind of, your mind.
Căng thẳng có thể dẫn đến triệu chứng khó tiêu, ở nóng. Dùng Gavisco Duo Action tạo thành một lớp gel axit antidic ngăn trào ngược dạ dày thực quản đến 4 giờ và trung hòa axit dạ dày, làm dịu nhanh chóng triệu chứng khó tiêu và ở nóng. Gavisco Duo Action chứa natri antinat, natri bicarbonate và canxi carbonate. Không dùng Gavisco Duo Action cho người quá mẫn cảm với bất kỳ thành phần nào của thuốc, bao gồm các parabens. Đọc kỹ hướng dẫn sử dụng trước khi dùng.
Mindset should be is every dollar is so important when you're investing, okay? Whether you've got $100,000 account and you're investing $1,000, that's still important, okay? Whether you're investing $10,000 and you've only got $10,000, whatever amount you're investing, your philosophy and your mind should really be like, this is super important. Every dollar is important. You should never like take for granted an amount of money, even if it's a smaller amount of money compared to your account, even if it's only 1% or 2% of your account. Always treat every dollar like it's super important. That way you'll always be in the mindset that this money needs to go toward the best stock possible, okay? The best stock possible. Now also, for investing, as far as beginners go, what type of companies do you want to kind of stick to as a beginner in the stock market? Obviously, we talked about you pretty much just want to go long shares. As far as the type of companies you want to get involved with as someone as a beginner in the market, and this is kind of the last thing we'll talk about here, is you want to get into bigger companies, okay? You want to get into big companies, okay? What do I mean by big companies? I'm talking market caps of 100 billion plus, okay? A market cap of $100 billion plus, okay? Huge corporations. These are, you know, we're talking the Apples of the world, the Googles of the world, the Microsoft, Amazon, Walmarts, you know, these huge companies, you know, Alibaba. Those are the type of companies, I'm not saying any of those specific stocks you can get involved with, but I'm talking about those massive type of corporations are really the ones you're going to kind of want to stick to as a beginner. Why? Well, one, because you're probably going to understand them better. You'll probably understand, you know, what they're doing and those kind of things better because you're familiar with them. I mean, a lot of you guys probably use Apple products or use Google products or Microsoft products. You probably understand Microsoft's business model before you really even buy into that stock, or Apple or Google. You probably understand a little bit about it before you've ever even looked into that company. Some of these smaller companies, sometimes it's a lot harder because you're looking into this company for the first time ever. It's going to be really hard to understand. Also, generally speaking, these type of corporations, as far as losing money and their stocks going down massive, it's pretty rare. It would be pretty rare for these type of companies, you know, on a mass scale to drop 30, 40, 50% in a year, okay? That's a pretty rare occurrence when we're talking about this size of companies. These type of huge companies, even if they were to fall 10 or 20%, would be huge. However, smaller market caps, you know, companies that are in a couple $1 billion or something like that, if they were to fall 50% in a year, that happens all the time. Like that happens all the time to smaller companies. Like they drop 50, 60, 70% in a year. Like that can happen in a snap of fingers. These type of big corporations, like if Apple stock magically went down 50% next year, it would be like earth shaking. Like if Google stock went down 50% next year, like that would mean the whole world's in chaos or something. Like that would be insane, guys. So stick to bigger companies, and also a lot of those bigger companies pay you out dividends, meaning you'll get a little more income into your portfolio. You don't have to worry so much about gains. You can get some dividends in. You understand these companies better. Stick to the bigger ones. Just go long shares. Don't mess around with some other things like that, guys. Don't mess around with short selling when you're new to the markets. Don't really worry about options when you're new to the market. If you want to learn about it, that's fine. So anyways, I hope you guys enjoyed this. That is your stock market for beginners playbook. If you want to know exactly how I personally pick stocks and what I look for in stocks, click that first link in the description down there. That's my stock market investing mastery course. That's an 11-part course. It even has my private email address in there. So if you have any questions in regards to the course, you can contact me personally and I will contact you back and answer any questions for you guys. Thank you for watching and have a great day.
Hi everyone, this is a Focus Spender, and today I'm going to be talking to you about the investing platform Robinhood. I invested a little over $500 on the platform about 1 month ago, and today I'm going to be sharing what I invested in, my gains and losses, a quick tour of the platform, and pros and cons on Robinhood. But first, if you're new to my channel, I would love for you to subscribe. My channel is all about getting out of debt, staying out of debt, organizing your finances, and increasing your net worth. So let's get started. So I must say that I didn't really know much about the platform Robinhood before I decided to give it a try. I would see videos pop up on my YouTube feed. Every so often people would ask me for my opinion on the platform Robinhood, but I couldn't give any answers because I never checked it out for myself. I decided to just jump right in, create an account, and just give it a try. So if you don't know anything about Robinhood, Robinhood is a free investing platform where you can buy stocks, ETFs, options, and cryptocurrencies. They have an online version and they have an app for your phone, so you can purchase stocks wherever you are, or you can just do it on your computer. So like I said, first I'm going to give you a quick tour of the platform, and then I'm going to talk about what I purchased and how I did, and then I'm going to give you pros and cons. And I have left markers in my description box letting you know exactly when I'm talking about each subject, so you can just go ahead and skip over to the part that most interests you. So let's start with this tour. Okay, so this is the home screen of Robinhood. It's pretty bare. It has this black screen with white letters, and red and green, and it's kind of giving me day trader vibes. So on the left, we have our top movers, which are the stocks that have had the biggest gains or the biggest losses for the day. And then underneath that, they have the recent news. So it's just information on various stocks that have been in the news in the last couple of days. On the right-hand side, they show my stocks here, a little bit of information on like a high-performing cryptocurrency, and then they show a watch list. So the watch list are, just very popular stocks that people are interested in, like Apple and Twitter and Tesla and Netflix. So now let's say you want to purchase a stock and you want to purchase stock in Home Depot. You would go ahead and type in Home Depot and click on that stock. And then here it shows the purchase price. It shows tags. They call them collections. So this stock is in the retail collection, construction, and building materials. So if you click on this, it'll show other stocks in that collection. Now, you can only buy whole shares. So if I want to buy a share, I can select 1, I can select 2, but if I do 2.5, it's not going to actually let me purchase it, even though it looks like it for 2 seconds. Then you click on review order to actually purchase the stock. As you can see here, I have $16.98 in my buying power, meaning I cannot afford to buy the stock. It gives you a little bit more information underneath about the company and about the company in the news as well. And so let's say I want to look at stocks in the retail collection. I can click on retail. So now I'm in the retail section and I can sort this various ways. I can sort it by popularity. I can sort it by analyst ratings. So if I want to see the most recommended stocks in retail for Robinhood, I can do so here. So I can look at Camping World, Dave & Buster's, etc. Now, the one thing they don't do on their homepage or anywhere else is have a place where you can filter by collection. So if you want to look at different sectors, you kind of have to just guess to see what collections they might have. So I can look up real estate. That's pretty simple. They have real estate collections, but they also have collections by popularity. So I can do the 100 most popular and get that collection, or I can do under 25 to find popular discounted stocks. So most popular under 25. So now how did I do? So like I said, I deposited $500 into the account, and it took a couple of days for the money to settle. So once the money was available for me to purchase the stocks, I would log back into the account, and then it was time for me to purchase stocks. And they don't have, like the Stash app, they don't have like prepackaged bundles where you're like, oh, I'm gonna invest in, a bunch of stocks in the tech industry or in the automotive industry. You pretty much need to know what you want to buy, because you're just gonna log in and start searching for stocks. So what I did was I looked at the top mover section, and I looked at the items that were in the watch list, and I looked at the items that were in the news feed to get ideas of stocks that I might want to buy. And so one stock that stuck out for me was that Cara Therapeutics. And I don't even know, all I know about the company is what I've read on Robinhood, but it had a 100% analyst buy. So I decided, okay, that's going to be one of my stocks that I buy. And then from there, as you can see on the screen, I also bought Pandora, I bought Fitbit, I bought Southwest, and I bought some shares in Dropbox. Now, what I really wanted to do was to purchase $100 in each stock, but they don't offer fractional shares. So for some stocks, I purchased $90 worth. Others, I might have purchased up to $120. And my original purchase price was $493.24. As you can see from the screen, I made gains in 3 different stocks, and I had losses in 2 stocks. So I gained on my stocks with Cara Therapeutics, Pandora, and Southwest. For Cara, I made $13.44, Pandora $19.08, and Southwest $6.78. And I had losses on Fitbit and Dropbox. Fitbit was 54 cents, and Dropbox was $10.94. And I should say, they definitely do not recommend you to buy Dropbox. So that was just me, being contrary. So overall, I invested $493.24, and my current value is $521.06. So my account has grown by $27.06, or 5%, which I think is pretty good for just 1 month. If you saw my tour, you saw that my account balance was higher than 521. I do have 1666 or 1698 in purchasing power, which was just leftover money from a few transactions. Now, pros and cons. So let's start with the pros. So like I said, it's a completely free account. You're not paying for anything. You purchase your stock, and that's it. You don't have to pay an annual fee, a monthly fee, a trading fee, no types of fees. And I think that is the biggest pro, because a lot of times, I remember there was a time when I was first starting to invest many years ago, and I would buy stocks, and like a trade would be $4.95 or $9.95, and I kept hearing about different methods where you should be buying stocks once a week or once a month, and I'm thinking, this is just eating away from the money I can use to invest. And so this really lowers the barrier to entry, where you're just paying for the stock and you're not paying anyone else a fee. So another pro is that they have a pretty simple interface. There's no bells and whistles, as you can see. I'm someone that likes all the bells and all the whistles, so this may not be a pro for me, but it's a pro for other people. Another pro is that they do have analyst recommendations, which can be helpful when you're just looking to figure out, well, I don't even know what stocks to buy, but now at least I can sort by the sector, and then I can see, what analysts are suggesting that you purchase. So I think that is very helpful. And I do appreciate the fact that they build news into the platform. So a lot of times if you want to look up a stock, or if you want to just hear news, you have to go someplace else. But here, it's right there in your face. Like, here are the stocks that are doing the biggest or losing the most right in the platform. So here are my cons. So I don't like the fact that you cannot buy fractional shares. And I know that with larger investing platforms, you can't buy fractional shares either. But with these new disruptor investor apps, a lot of them are letting you buy fractional shares into stock. And I think that is very important to get, someone that doesn't have as much money as the next person to get started in investing. You might want to invest in Netflix, but you don't have $300 or $400 to buy one share, but at least you can put in $100 today, and then next week you can do another, or next month, however you want to do it, so that you can at least get into the game. Another con is that it doesn't allow you to reinvest dividends, which is very important. I like when I get a dividend that the money just gets reinvested into my stocks, and I just automatically purchase more and more shares without me having to do any work. So with this, I got dividends from Southwest, and it's only 32 cents, but it's sitting in my purchasing power. And as I gain more and more investments, it's going to sit in my purchasing power until I have enough to buy another share of stock wherever I want to buy. Another con is that you cannot auto invest. So everyone knows that I love Betterment. I have links to Betterment videos below. But what I love about that system is that you schedule your investments with them. And every 2 weeks or every time you get paid, however you have your schedule, you automatically invest into your investment account. And that has been a game changer in my investing life, where I'm not thinking about, wait, did I invest this month? Do I need to look at a calendar? How am I going to set this reminder to invest? So with Robinhood, you have to take that active role and log into your account, however often you want, and setting up your investments. It'll go through the next day, but it's not, an auto invest. What they do let you purchase option contracts. So if you are watching a stock and the price dips to a certain level, it'll automatically trigger that, option to buy or the option to sell. But in terms of auto investing, no, can't do that. Now, who would I recommend Robinhood to? I would recommend Robinhood to the person who buys stocks on a regular basis. Not a day trader where you're buying and selling every single day and throughout the day, but someone that likes to purchase stocks on a regular basis. This is perfect because it's free. You don't have to pay that $5 or $10 commission. You can just buy as many stocks as you want, and there's with however many companies, and never pay a fee. I also recommend this to people who pretty much know what it is they want to buy. You already know how to build a diverse portfolio, and you don't need that much help. I want to buy 10 shares of this stock. I want to buy 5 shares of this stock. You're very clear on what your goals are. This is perfect for you. Now, who do I not recommend this to? I don't recommend this for that person who has no investments and is looking to invest a lot of money. There's people out there who are not investing in their 401k, 403b, who don't have an IRA, who don't have anything like that, but for some reason have a large lump sum of money and are just looking to invest. No. Do that at your own risk, but I would not recommend that to you. I would say if you have a large sum of money, you want to put that money in a diversified portfolio. And then if you want to take a little bit of money and play around with it, well, then you can play around and purchase some shares of whatever stock with Robinhood. But I would not, all of a sudden I have no experience in investing. I have this large lump sum of money. I'm just going to go put all of my money in a couple of stock and see what happens. This is not for you. This is a simple platform, deceptively simple platform. So I think it's really more for people who really know what they're doing. So will I continue to use it? I think so. Actually, no, I definitely will continue to use it. Honestly, throughout this last month, I wanted to go ahead and start investing more, but I figured, I wanted to see what happened to my initial $500 investment before I started adding investments to it. So I'm definitely going to keep using it. I feel confident that it's okay for me because I do have my 401k, my Roth IRA, traditional IRA, I have my Betterment. So this is just something where I'm not even going to put that much money in it on a regular basis, but maybe, every month, maybe I'll invest a $50 or $100 just to continuously increase on my investments. And full disclosure about me, I don't actually like buying individual stocks. It's a little nerve-wracking to me because I in the past have picked a couple of really good winners, but I've picked way more duds in individual stocks. So I'm definitely going to be utilizing that analyst rating to pick my stocks that I decide to purchase. And I'm also going to do a little historical analysis before I buy a stock. So if a stock is trading really high And I noticed that, well, over the last year or over the last 5 years, this is the highest it's trading at. I'm probably going to actually wait until the prices come back down to, average to make my purchase. So that's going to be my strategy going forward using Robinhood. So I hope you liked this video. If you do, be sure to hit like, hit subscribe, click on those bell notifications if you want to see more videos like this, and share with your friends. Also, comment below. And you can find me on Twitter, Instagram, and Facebook at FocusSpender or at www.focusspender.com. Thanks. Bye-bye.
Stock Market for Beginners 2019 edition. Welcome in, guys. If you're new here, I am Jeremy. This is the Financial Education Channel. And here today, if you're a beginner in the stock market, you are in the right place, okay? I'm going to take you through some of the most important questions you got to ask yourself if you are a beginner in the stock market, and kind of like, how do you invest in stocks? We're going to answer some of the most popular questions out there. What are stocks? What is the stock market, okay? Where do you buy stocks? How do you make money from stocks? What are different stock market strategies? There are a ton of different strategies. Like, what are they, okay? Where do you learn about stocks, all right? How are your gains taxed? So if you make money on stocks, like how are they taxed? Are they taxed differently than regular income, all right? How long to know everything? Like how long does it take to kind of accumulate a lot of knowledge in the stock market? How much money should you put in your first year of investing? If you're lazy, can you still make money from stocks? And is it even worth investing small amounts of money? So we're going to go through all those today, some of the biggest questions out there. I hope you guys get a tremendous amount of value out of today's video. We're going to go through all this. Hit a thumbs up if you do. If you're looking for more premium courses on stock market investing, I have those linked in the description so you can check out that if you are interested, all right? So first thing, what are stocks? How I want you to think about a stock is it's basically ownership in a company, okay? It's ownership in a company, and that's how you should be thinking about stocks, all right? So if you buy one share of Apple stock, for instance, right? You are now part owner of the Apple Corporation. You are a very small owner of Apple Corporation, but you are technically part owner of Apple stock, okay? You go and buy one share of Coca-Cola stock or 10 shares or 100 shares, you are part owner of the Coca-Cola Corporation, all right? And the more shares you accumulate, the bigger as a percent of an owner you are, all right? Now, as most people, most average Joes out there, if you're investing, you know, let's say thousands of dollars, even hundreds of thousands, you're a very small owner in that company, but you are still an owner of the company. And these stocks trade on the stock market, which is basically where shares are exchanged, okay? People are buying and selling stocks constantly for many different reasons, all right? The market's open Monday through Friday. It's open 7 hours a day, every day on Monday through Friday, unless it's like a holiday or something like that. Then the markets are closed. And you can sell these stocks anytime you want. You can buy them anytime you want. And you are literally part owner of a corporation. That's how you should think about it, okay? And it's pretty cool because you can think about it. Like you can go from basically having no ownership in anything in life to you're actually part owner of a major corporation. It's cool. You're a very small owner, but it's still really cool, guys, okay? Now, where do you buy stocks? Like, where do you actually buy stocks at? There are a few different apps and different platforms and whatnot. I'll kind of talk about two. So most people, if you're a beginner in the stock market, and especially if you're investing small amounts of money, there's an app called Robinhood that's more than likely going to be good for you, okay? This app called Robinhood is awesome for most beginners in the stock market because they don't even charge commission. So essentially meaning that you can buy a stock and they don't even charge you for buying that stock, okay? You just have to pay however much the shares were. So let's say you were buying Home Depot shares, right? And let's say Home Depot was trading at $100 a share. All you need is $100 in your account and you can buy that Home Depot share for $100. They don't charge you a commission on that, where almost every other platform out there actually charges you a commission, meaning that you have to actually pay a fee every time you buy or sell a stock, okay? So for most beginners in the stock market, Robinhood's good. You know, customer service levels maybe not as good as some other platforms and whatnot. The one I mainly use is a company named Fidelity Investments. Okay, I've been using them for a long time, and they're phenomenal. They're about $5 commission trade per trade placed out there, whether you buy one share or 1,000 shares or anything across the board. They charge about $5, but Fidelity Investments, I really love them because they have really good customer service, okay? I feel like they also have good security and things like that, but customer service, like I can call them up any time of day and they're there to answer my questions, okay? So, and there are other ones you can do out there. They're like Scottrade, E-Trade, and TD Ameritrade, and some other different platforms, but in my opinion, like, it depends. If you're looking for really good customer service, you're probably going to want to go Fidelity, and especially if you got bigger amounts of money, probably Fidelity. If you're investing smaller amounts of money and you don't care as much about customer service, you just want to, you know, place trades with no commissions, the Robinhood app is going to be phenomenal for you guys out there, okay? Now, this next one, how do you actually make money from stocks, all right? So as a beginner in the stock market, there are essentially two main ways you're going to have a chance to make money from stocks, all right? There are more complicated ways to make money from stocks that we're not going to get into, in options and things like that. We're not going to get into that because this is a beginners in the stock market video here today. But essentially, how you can make money from stocks is you buy a stock, okay? Let's say you buy this stock, ABC, and you buy it for $100 a share. Hopefully, over time, holding those shares, it goes up in value. It appreciates, no different than anything out there, real estate or something like that, right? And hopefully, eventually, you know, all of a sudden it gets to $120 or whatever price, and you decide to sell out. And you know, so you sell out for $120, you bought it at $100, so you made a $20 profit per share on that stock, all right? That's one way you can make money from stocks as a beginner in the stock market. The other way is through collecting dividends. So just about say not all companies pay a dividend, but there are a lot of the bigger companies out there, which are mostly the companies you'll want to invest in as a beginner in the stock market. They pay a dividend yield, okay? So meaning you can basically buy these shares and you get paid dividends every 3 months, generally speaking, okay? So let's say this stock has like a 2% dividend yield when you buy it, okay? So that means each year you're going to basically receive $2 in dividends per share you own in that stock. So you just hold that stock and you get dividends paid out every 3 months into your account, okay? If it's a 2% yield, then over the course of a year, you'll get $2 in dividends. Now, one of the great things about dividends is a lot of the bigger companies that are very profitable and very well run, they actually raise their dividends over time. So although you first buy the stock and you're getting $2 per share paid out to you per year, right? All of a sudden, over time, as long as they continue to execute on their strategies, all of a sudden, over time, you can start getting $4 per share and then $6 per share. And their dividends generally increase. There are a massive amount of companies out there that have consistently raised dividends for like 20, 30, 40, 50 years in a row. And these dividends get bigger and bigger. So though you buy in and you might only be collecting $2 per share, all of a sudden, over time, it goes up and up and up, okay? So those are two main ways as a beginner in the stock market you can make money. One is by your shares increasing in price over time and you selling it for a profit. And the other way is obviously through collecting dividend money, all right? Just one disclaimer about dividends is you don't always count on dividends because a company can cut dividends at any time they want. Most bigger companies usually don't unless they go through some big financial troubles and you want to stay away from those kind of companies, all right? So that kind of covers the main ways you can make money from stocks overall. Now this next one, what are some different stock strategies? And there are kind of like I would say three main stock strategies out there. And almost everything branches off of these three stock market strategies, all right? And I'll tell you which one I do. So the first one, this one I do not do, but there's one called day trading, okay? There's one called day trading, and there's another one that's called swing trading, okay? And once again, almost every type of investing or trading goes off of these three strategies. And then there's long-term buying, okay? Buying and holding, basically, okay? And almost everything comes off of these three strategies, okay? One strategy, two strategies, three strategies. Now, the goals of each of these are very, very different, okay? A day trader is generally trying to get out of a stock very quick, okay? So they're trying to capitalize on a very small movement in a stock, and basically that's how they're trying to make money, okay? So they buy a stock, and if it goes up a few cents or a dime or whatever, they're going ahead and selling it and trying to book a profit that way, all right? That's one strategy. I definitely don't do that one. Swing trading is more like, there are a lot of different ways you can swing trade, but it might be something like you're really bullish on the market coming up this upcoming week. You think, the government's going to come out with some good economic data. You think a specific company is going to come out with some amazing earnings or something. So you go ahead and buy a stock for the short term and try to swing trade and hope it goes up and everything goes your way, and then you sell out and hopefully make a profit, okay? That's another strategy that's also a short term in nature, but generally this is much longer term than something like day trading. Usually swing traders are doing something for a full day or maybe even a full week or maybe even a full month type play, where day traders are literally just getting into stocks like within minutes or something like that, okay? Sometimes even seconds with the machines. Now, the one for me personally that I really like is long-term buying and holding, okay? So there are a lot of different strategies even in long-term buying and holding. There are different strategies like some people buy stocks and they say, I'm going to take this stock to the grave with me, as in they'll keep that stock forever. So they buy a stock and they just hold it for their entire life, okay? And hopefully over time they get paid out massive amounts of dividends and those shares appreciate over time, and that's awesome for them, okay? There are some people that are like, I'm buying a stock for at least 10 years. My kind of horizon for long-term buying and holding is more like 3 to 5 years out is what I'm looking. It doesn't mean I'll always hold a stock for 3 to 5 years, but when I'm thinking about the company, I'm kind of thinking like 3 to 5 years out, because that's what I can kind of like realistically see. 10 years from now, that's too far into the future, okay? That's too far into the future. And if I'm thinking only like 1 to 2 years out, in my opinion, that's just too short term in nature. So I really got to think like, where's this company going to be in 3 years from now, 5 years from now, maybe even 7 years from now? That's kind of my strategy there. And I'm basically buying those stocks. Sometimes it's to collect dividends, depending on the stock, but sometimes I believe those companies are going to appreciate greatly over the next 3, 5, 7 years because they have a lot of bullish vectors going for them, okay? And this is the one that, in my opinion, most people can pull off, okay? I think most people, if you have a work ethic, you have passion for investing, I think most people can become long-term investors in companies, all right? This is Warren Buffett type philosophy, where you buy stocks and you hold them for several years. Hopefully they appreciate over time and you can collect dividends if it's a dividend-paying company, all right? These other ones are much harder challenge in my personal opinion, okay? So those are your strategies out there. I'm definitely down here with the more of a long-term buying perspective, all right? Now, by the way, and you can sell a stock at any time. So if you're just wondering, like, how long do I have to hold a stock for? Like, you could buy a stock and within seconds you could sell that stock if that's something you want to do or something like that. So that's one of the beauties about stock market investing, is it differs from a lot of other things like real estate investing. Like, you can't just magically sell a real estate investment property or something in seconds. A stock, you can get out of it in seconds, okay? So the question is, where do you learn about stocks? So the best place to learn about stocks is, let's say you find a stock, okay? Let's say you want to look into Google stock, all right? Let's say Google, you're like, man, I like Google. They own, cloud products. They obviously own Google search engine. They own YouTube. Google, I want to look into this company, okay? I want to research it. How do I go about researching this? Well, you go to actual Google search, and then what you do is you just type in Google Investor Relations, okay? Investor Relations, all right? And when this is typed in, basically, generally speaking, almost every single time, whatever company you search, Investor Relations, it's going to be the first tab that comes out. So you can type in, if you want to look into Coca-Cola, you could type in Coca-Cola Investor Relations. If you want to look at Pepsi, you can say Pepsi Investor Relations. Apple Investor Relations, generally going to be the first thing that comes up in the Google search engine, okay? So you go ahead and click that. Now you're into the Google's Investor Relations page. And one of the places I would like to start is what's called the 10K, or the annual report, okay? The annual report. And I suggest you read through this entire annual report, 10K. You're going to find out so much incredible amount of information that's going to give you, a very good understanding of that business model overall, all right? In the 10K annual report, you'll see all the financials of the companies. We're talking income statements, the balance sheets, all those type of things, where balance sheet is, like how much money they hold in cash and investments and things like that, versus some of their debts and things like that, where income statements more like how much revenue is coming in the door and how much of that revenue is actually reaching to that bottom line in the profit engine and things like that. So 10K annual report, you're going to find out so much good things in there. You're going to find out, their strategies. You're going to find out who their competitors are, why their business was up or down versus last year. Almost anything you could possibly want to know is going to be in that 10K annual report, okay? After you're done that, then I suggest you listen to the latest conference call, okay? Companies will all have their latest conference calls available for the last quarter they did, and listen to that kind of fully and just kind of, judge off that. Then after that, I suggest you read what's called a 10Q, which is a quarterly report, which will also be on their investor relations page. And after you've done all three of these things, you should have a pretty good understanding on if this is a business you are interested in looking more into, okay, in the future, as far as like looking at P ratios and things like that. And if it's something you're still not, you still don't understand the business, you're like, I don't have any clue, and you've already read the full 10K, you've listened to the latest conference call, you've read the 10Q, and you still have no idea like what that business does or its competitive advantages or why their business is good or bad, then it's probably not the company for you, and you should probably look into another company, okay? Generally speaking, after you've done all three of these things, you should have a pretty good understanding of the business. But if you just can't wrap your head around it, move on to the next one. There are thousands and thousands of stocks out there to look into. So if you don't understand one, like, don't sweat it at the end of the day. But that's what you're going to want to do. Then you can use websites like Yahoo Finance and websites like CNBC and some other different websites out there to kind of look at PE ratios and different statistics like that. But here is the juice of it, okay? Here's the meat, the investor relations page. That's the main place you're going to want to learn about companies, because they're going to have the most accurate information on there, and pretty much anything you possibly want to know about a public company is going to be disclosed in there, all right? Now, let's get into number 6. How are stock gains taxed? Very important question here, all right? So stock gains are taxed differently depending on how long you hold a stock for and depending on if you receive dividends. So if you receive dividends, first off, okay, remember we talked about those good old dividends just a minute ago? If you receive dividends into your account, that's basically going to be taxed at, right now, I believe the government's taxing those somewhere around a 15% rate, and I think it can go up to just under a 20% rate if you get like a huge amount of dividends or whatnot. But for most people, you'll be taxed at around a 15% rate, which is great for most people because that's probably a lower tax rate than what you get taxed at your job or something like that. And then basically, if you hold a stock for more than 1 year and sell that stock for a profit, you're going to also be taxed at around this 15%, unless you have a huge, huge positions and like hundreds of thousands or millions of dollars in profits. Then I think you're taxed a little bit closer to 20%. But for most people out there, you're going to be taxed at 15% if you've held that stock for a minimum of 1 year and you went ahead and sold it. Okay. Now, if you hold for less than 1 year, you hold a stock for less than 1 year and you sell a profit, then you're taxed at your income tax rate, which is generally, pretty high. I mean, most people probably pay an income tax rate in the 20s, and if you make a lot of money, then you're probably paying closer to the 30s. So you can see a big difference. If you hold a stock for more than a year, the taxes are definitely on your side at the end of the day because you're paying a 15%-ish rate versus 20 or 30 or 35% rate or something like that, okay? And so it's a big tax advantage to kind of being more of a long-term investor and even a dividend investor versus someone that's doing short-term activities just because you're taxed at a much higher tax rate, all right? All right, let's get into number 7 here. How long until you know everything? All right, I hear a lot of people ask me this. Like how long does it take till you know everything? First off, you will never know everything, and I just don't suggest you go into anything in life and kind of like with the mindset of, oh, I'm going to know everything about this in 1 year or 2 years, and like I know everything. In my opinion, you can get a very good understanding of stock market investing within 1 to 2 years. Okay, within 1 to 2 years. You should have a very strong understanding of stock market investing as long as it's been something you've worked on each and every week for a year straight or something like that. You should have a very good understanding of stock market investing, how it works, good companies to invest in versus bad companies, things like that. But in terms of knowing everything, I don't think you ever know everything. Like I've been in the stock market for 10 years. I wouldn't consider myself, I know everything about the stock market and like I'm a genius. And same thing, I hope I never get that mentality. Even when I hit 20 years in the market, 30 years, do you get a lot of experience? Yes. And as time goes on, everything is cumulative in this game, meaning you get smarter and smarter with your decision making over time, okay? And as long as you stay away from bad things and bad decisions as far as like margin and things like that, which we won't get into in this video, but don't ever touch margin, something like that. As long as you avoid things like that, like your decision making process, your understanding of companies, everything's very helpful. Your understanding of stocks, and think about it this way, like for instance, I've been in the stock market for 10 years. The amount of stocks I understand their business models and I haven't looked into them, let's say in a few years, all I have to do is do a quick refresh of that company and I'm already like I have thousands of companies in my head already. Imagine somebody like Warren Buffett that's been doing this for 60 or 70 years. So everything's a gain, a gain as time goes on. Everything is cumulative and you get more and more knowledge, but don't ever consider yourself as, oh, I've been doing this for 2 years, now I know everything. I just don't think it works that way. You're always getting smarter. Your decision making should get better and better as time goes on, all right? So that answers that question. Number 8, how much money should you put in your first year? Well, in my opinion, once you have looked at your stock market strategy and you decided which one you're going to go after, and you decide like what type of stocks you want to invest in my opinion, it's better to start small. Okay, the reason being is, and by small I mean generally hundreds of dollars or maybe $1,000 or a few $1,000s or something like that. It's generally better to start smaller, and that's why I love when younger folks get started investing, people that are just 18, 19, 20 or in their 20s or something like that, because generally speaking, if you're in those age brackets, generally speaking, you don't have much money to your name yet. I think that's the best position. The ones I worry about is a person that is 48 years old, they study stock market investing, they learn the strategies, and they think they're ready to go, and they got $500,000 saved, and they put all $500,000 or $250,000 of those dollars into the stock market right off the bat. That, in my opinion, don't do that type of stuff, okay? The best position is when you got only hundreds of dollars or a few $1,000s, and and you start off small like that, okay? And you start building up. Because here's the thing, you got $100 saved or you got $1,000. Like if you lose some money and your stocks go down, 10% or whatever, let's say it goes down 30%. Okay, so your $1,000 went down to $700. It's not like that extra $300 was some magical money that was so important in your life, right? Whereas it's a big difference. So let's say you invest $500,000. Let's say you had 500K saved, and let's say you lose half that money. Also, you lose 250K or something like that in a very quick amount of time. That's not the position you want to be in. So in my opinion, you should start with smaller amounts of money, generally in the hundreds of dollars or $1,000. And as you get more and more experience, as you get more comfort, as you get more confidence in yourself that you can do this, you can pick individual stocks, then you can go bigger and bigger as time goes on and as the years go on. But in my opinion, that first year, the second year, don't go crazy with it because, it's too dangerous for you because you lack the experience at that particular time, okay? Now into number 9, only 2 left here. Let's say I'm lazy, I don't want to do stocks, okay? So let's say you are, you're lazy. You don't want to look into the investor relations page. You don't want to read the annual reports, the 10Qs. You don't want to listen to conference calls. You don't want to study companies. Can you still make money from the stock market? Okay. Yes, you can. Okay. Basically, you can still have a 401k at your workplace if you work for a company. You can buy an index fund or something like that. That basically just, tracks the market and however well the market does over time is how well you do over time. Something like that. That's perfectly fine. You can still benefit from the stock market over time without picking individual stocks. In my opinion, if you have passion for it and you have the work ethic, I think picking individual stocks is great. I think it takes your financial power into your own hands rather than having somebody else dictate that financial power. I think it's great, but it's not for everybody just because some people just don't want to put in the work ethic or they don't have they just don't have the confidence in themselves to make the investment decisions and say, Apple stock is undervalued here, okay? Amazon stock, they're gonna go bigger in the future. I'm investing in Amazon stock. Shopify, I love Shopify. I believe in that company a lot over time. I think it's gonna grow massive over the next 5 to 10 years. Tesla, I wanna buy Tesla stock. Some people don't wanna deal with that and they don't wanna deal with the volatility, and that's fine. You can still benefit from the stock market, just max out your 401k and maybe invest in index funds that track the stock market or whatnot. There's no shame in that at all. The name of the game is growing and growing and growing. I think it's definitely possible to outperform the markets over time as a long-term investor as long as you put in a good amount of work ethic and stay disciplined. But if you don't do that, you can still benefit a lot from this, okay, guys? And the last one, number 10. This is a question I get a lot. Is it even worth investing small amounts of
Tết về phát tướng, sao chưa phát tài ta? Heo chiêu tài, có đôi tài chiêu tiền. Heo không đợi ăn dưa, heo không thèm bánh mứt. Heo chỉ cần thanh toán Zalo mà hỏi. Sao nêu lên hôm nay, nuôi heo bằng thanh toán. Lì xì Zalo Pay, heo mình chọn phát tướng. Đặt heo phát tài.
Heo phát tướng, ví phát tài, Zalo Pay ngay.
Money. Remember we talked earlier just a few questions ago, oh, how much do you need to start in the stock market, or how much should you be investing? Oh, that's only a few $100 or $1,000. And some people say, man, is that even worth doing? Because let's say you have $500 in stocks, right? You start out, you have 500. Even if you double that up, you only get up to $1,000. And some people are like, oh, is that even worth doing? Is it even worth going through the work and whatnot? In my opinion, it's 100% worth it in the end. Because here's the thing, you got to understand, everybody starts somewhere in this game. My first investments were like $200 or $300, all right? And nowadays, I'm investing tens of thousands or hundreds of thousands of dollars at a time, all right? So the fact is, you gotta get started somewhere when you start in this game, okay? Whether you're talking about $300, $1,000, $2,000, $800, it doesn't matter, guys. And now with the Robinhood app, because you don't have to pay commissions, you can invest like $50 at a time. It doesn't matter in the end. The name of the game is just getting started, okay? Get started in this. If you get started in this, you're gonna likely do very well for yourself over the next 10, 20, 30 years, and as long as you stay disciplined and you put in the work ethic toward it. But if you always view viewing it as, oh, I don't have enough money to get started, I only have a certain amount of money, you're never going to get started, generally speaking. That's just the way it works, guys. So in my opinion, it's better to start when you don't have a lot of money, because like we talked about earlier, say you saved a lot of money. Let's say you have a good job, you saved yourself a lot of money. You didn't learn anything. You can't learn by just watching stocks all the time. You got to be in the game, right? I can go down to the basketball court and shoot shots all day, but until I play a game with somebody, I don't know how good I am. You don't know how good you are in stock market investing. You don't know how you're going to react until you actually have money in the line. And it's much, much better to, in those early years, those first 1 to 3 years in the stock market, to be playing around with smaller amounts of money rather than, oh, I saved $50,000 and my life savings $50,000, I'm dumping it all in the stock market. That's a much more dangerous game, guys, especially when you're going right off the bat like that. So there's no amount of money that's too small. The name of the game is just to get started. All right, guys, I hope you got a ton of value out of this video. Hit a thumbs up if you really enjoyed it. Make sure you follow me on Instagram if you have not already. Thank you for watching and have a great day. 10 high growth stocks that I am thinking about buying. That's what we're talking about here today, guys. I'm going to give you 10 stocks that are very fast growers. These type of stocks are literally changing the world. They're literally changing industries. So I hope you guys really enjoy this today. I hope you learn a lot from it. And I hope you kind of find some companies that maybe you want to look into a little further that maybe you haven't heard of before. Now, here's what I'm thinking about doing. I am thinking about creating a separate account, okay? A separate, basically, brokerage account that is just for super fast growing companies, okay? Just looking at it from the perspective of, I want companies that are literally changing the world, that are doing huge things, that have monster growth going for them, okay? That's all this account would be focused on. And I would turn a blind eye to two core things, okay? I would turn a blind eye to balance sheet, and I would turn a blind eye to PE ratios. And if you know anything about my investing style, I value PE ratios a ton. I value balance sheets a ton, okay? So I would kind of turn a blind eye to these two things, all right? So if you don't already know, basically between my wife and I, we have 5 different investment accounts, all right? My first one is my main private account, okay? This is a private account. No one knows what's in there. No one knows what I own in there except me, like no family, friends. No one knows what's in that account, okay? Then I have what's called a public account. This public account now has over $100,000 in it, and I do it through Fidelity Investments. And this account, everybody in my stock market membership group gets to see this account, all the trades I make in there, the shares I have, the amount of money I have in them, whether I'm up or down on the positions, everything is full disclosure in that public account. Anytime I place a trade in that account, I update the group immediately. By the way, that group is half off right now for the remainder of July, so make sure you get in there if that's something that interests you. I also do lessons, teaching things. You have access to 2 of my courses in there, ton of different things. First link down in the description, half off right now. Then I also have a retirement account, okay? And then my wife, she has a regular brokerage account, and she has a retirement account, okay? So between us, we have 5 different investment accounts, and basically this would be the 6th account, and this would just be focused on high growth, okay? This would just be focused on high growth, just focus on companies that are literally changing the world and are doing huge things. Turn a blind eye to PE ratio, turn a blind eye to balance sheet. So I hope you guys really enjoy this. Let me know which of these 10 stocks you think I should buy. I would love to hear your guys' opinion down there in that comment section. If you guys own any of these stocks, if you have any insight on any of these type of stocks, I would love to hear from you guys as always. And let's get into this. Alrighty, guys, the time has come to reveal these 10 super high growth stocks that are literally changing the world. I hope you guys really enjoy this. Here are the first initials of all of them. Let's get into each of these. I'm going to kind of explain all their business models, okay? The first one here is one, I would say this one is probably one of the 5 most important companies in the entire world as far as changing the world right now. And their name is Alibaba. Alibaba out of China. This company is amazing. How many successful businesses this company has is amazing, okay? The first is you got to think about them from a marketplace perspective, okay? So picture you're going to a farmer's market or something. A farmer's market, it's like an indoor farmer's market. And picture there's someone that built the structure there, and they take a commission off of everything that everybody sells in that farmer's market, okay? That is what Alibaba does, but on the online space. So you can sell on Alibaba and they just take a small commission. But here's what's different about Alibaba and what makes Alibaba special. Alibaba does not compete with the people selling on their services, okay? They do not compete directly with them. They're not trying to take information and say, we're going to try to make money for ourselves based upon that information. No, they give that information to their third-party sellers and try to help build their businesses, and it just creates a never-ending stream of new people coming in, but there's always new companies coming in and trying to sell on there, and the big companies all want to sell on Alibaba. It's a much better company, in my opinion, than something like an Amazon, from the perspective of Amazon actually competes with a ton of their third-party sellers. You're watching this on a tripod right now, okay? There's a camera on top of this tripod right here. This tripod is in direct competition with Amazon tripods. So, all these sellers that sell tripods on Amazon, right? Amazon goes ahead and says, oh, you know what? We're going to make our own tripod. We're going to have it at this price point and we're going to rank it first. So if you type in tripod on Amazon.com, the first thing that comes up is an Amazon tripod. All the other hundreds of companies that make tripods are all at a disadvantage. Amazon is directly competing with the people that sell on their service. And I think it's kind of a slimy business model Amazon has, but they've done it very well, okay? They've done it very well. They built it up, but I think it's not the best business model. Alibaba, on the other hand, says we're going to be a marketplace. We're going to help all you guys sell. And as you guys have more success, we're going to have more success, okay? Then they also have Taobao, which is almost like an eBay, for the Chinese space. What you expect eBay to be in the United States, Taobao is kind of like that over there. They also have AliExpress, which is benefiting huge from the Shopify wave right now, okay? If you don't already know, people will start Shopify websites. They'll use Chinese brands, and who do they use? They use AliExpress. AliExpress makes money from all those commissions, all those people selling on Shopify that are doing great business. They're all going through AliExpress, okay? AliExpress is making a fortune. They have Alipay, which is a huge mobile payment platform. They have cloud infrastructure that is really going to start building over the next 5 to 10 years in a massive way. Those numbers, this is a business that's growing at 100% plus. There's so many businesses. I just touched on the main ones right there. They have so much going for them, guys. And these businesses are all pretty much going to a massive scale or already on a massive scale. So you're getting a lot of bang for your buck. And Alibaba is definitely one of the 5 most important companies in the entire world as far as changing it. Let's get into number 2. The number 2 stock is a fast-growing company. This company is growing in a major way, and they are disrupting several industries right now. They're disrupting several industries. Highly controversial stock. A lot of people love the stock. A lot of people hate it. Starts with a T. You may know what it is. It is Tesla. Tesla. This company is disrupting some major industries. First off, let's just they're disrupting the internal combustion engine. Okay, gasoline-driven cars, diesel-driven cars. They are completely disrupting that. They're going electric. They're moving us forward into an electric car world. Okay. The second one is a car world where we are driving to where the car is doing all the work. They are literally driving, and we can, surf on our laptops or look at our phone and watch YouTube videos on our phone or whatever while the car does the driving for us. They're disrupting in a massive way those 2 industries, and they are leading the way there, okay? Also, they're disrupting an industry that no one really talks about, and they're going to disrupt it in the sense of, will we even own cars in the future? Will we even, 10 years from now, let's say, will we actually own cars? Here's what Tesla could do. Tesla could start an Uber on steroids in the future, okay? Imagine a world where we're not so interested in cars, but there's a company that has an Uber-like service that is phenomenal that actually happens to make all the cars that have autonomous driving and are electric and have an entire network. This is what Tesla can be in the future, okay? They're disrupting so many things going forward. It is unbelievable, all right? Then on top of that, they're going to disrupt the energy sector with their storage products and their battery products. There's so much Tesla is disrupting right now. It's unbelievable. The only question with Tesla is, can they get through this little short-term clip here without maybe raising some more money so they can be successful? Even if they don't, they'll probably be able to get through it. And the amount of industries Tesla is already disrupting and will continue to disrupt over the next next 5 to 10 years, it's unbelievable. It's almost unimaginable, guys. So Tesla, a very fast growing company. They're growing revenues in a massive way. It's a company that, last year did somewhere around $11 billion. This year, they should do something around 20 plus. It is a very fast growing company and will continue to be for several years out. There are people that believe this company will bring in over $100 billion within the next 4 to 5 years. Over $100 billion in revenue within 4 to 5 years. This is a company that is completely changing the world. Let's get into number 3. The number 3 stock is a very fast growing company, and this company is growing an ecosystem that in the business space is almost like what Apple has done in the consumer space. It is absolutely amazing. And this number 3 stock is a company named Intuit. They're a very fast growing company, all right? Intuit, you might have heard them from TurboTax and some of those products, but it's not just that. It's what they can do on the payroll side, okay? For businesses and small businesses, all right? They also have a product named QuickBooks, which basically people pay a monthly fee to use QuickBooks, okay? A lot of people pay somewhere between $8 and $15 to use QuickBooks per month. It's a recurring revenue stream for the company, and the customer satisfaction on that product is unbelievable. It is growing in a massive way, okay? So basically what they're doing is Intuit is creating a system of different products that kind of feed into each other, okay? Imagine if you're doing all your business expenses and all those type of things, right, on QuickBooks, then you're much more likely to use Intuit's tax products, okay? And they also have tax products for accountants, okay? So now accountants are pushing their clients to use QuickBooks throughout the year, so their business is a lot easier, okay? Accountants' businesses are a lot easier. And they are expanding this company all around the world, and they're just creating products that feed into the ecosystem the same way Apple has done so successfully on the consumer side. Just Intuit's doing it on the business side, okay? Small businesses, which there are massive amounts, millions upon millions of small businesses and mid-sized businesses. Like I said, this company, it's not just like a one-time fee, like, oh, you just pay us $99 and you get our product. No, they make money every single month, $12 to $15 off of all these customers, and imagine millions of customers. These numbers start to add up, and it's straight profitability, okay? And then you just have products feeding into products and whatnot. So this company, Intuit, very fast growing company, unbelievable company. They're creating an ecosystem, very special. The profits are going to explode for this company over the next 5 to 10 years. And that's why it made the list. Let's get into number 4. The number 4 stock is a company that, listen to this, in the past 7 months, this company's stock is up 107% in a 7-month span, okay? 7-month span up 107%. This company is called The Trade Desk, okay? The Trade Desk. And what this company does is they provide a platform basically for companies that want to advertise on social media, whether it be here on YouTube or wherever it might be, okay? And allow these companies to do it in a smarter way than in the past, okay? Typically, companies would advertise, and there's a famous saying in basically advertising, right? The famous saying is, half the ads are working, you do, half the ads are not. You just don't know which ones are working and which ones aren't. And anybody that's run a business probably has felt that at some time. This company is helping with that, okay? And they also help with the auction process and letting companies know whether this is a good auction price you're paying for something, an ad here, or whether you shouldn't pay for that, okay? This company has phenomenal software suite, and they have extremely high customer satisfaction, okay? We're talking over 95% plus customer satisfaction with their products, okay? So generally, as soon as they sign up a big company or a mid-sized company or a small company, whoever it might be, they sign up one of those companies, good chance that company is staying with them long-term, okay? They have a very good product. Companies are smart. Businesses are smart. If this was a garbage product, that was a new product, this company's only been around since 2009, by the way. If this was a garbage product, companies would just get rid of it right away, okay? They would just cut it and be like, okay, we don't need that anymore. That's not cutting it for us. 95% plus of customers are staying with them. You're probably doing something right when you got those type of numbers, okay? Fast growing company. Like I said, stock is up over 107% in the past 7 months. So pretty impressive company. Definitely one worth looking into. Let's get into stock number 5. Stock number 5 is probably the lamest growth one on the list, okay? It's probably the lamest growth one. However, this company still has phenomenal growth going forward, okay? This company still has great growth. It's been growing for decades now. Still has phenomenal growth, and is a company named Google McDougal, otherwise known as Alphabet, okay? Google. Google, this company, the first thing you got to kind of exit out of your mind is you got to stop thinking about the search engine, okay? The search engine that is Google is not where the growth is at. That's where the profit engine is at, all right? The profit engine still for Google to this day is the search engine, all right? But that's not where you need to think about. There are 3 other businesses that Google owns that you really got to think about when you're thinking about the growth for Google, okay? And where the growth is coming from and going to continue to grow into the future, okay? The first one is the platform you're watching this on right now, which is called YouTube, okay? YouTube, the amount of hours watched every single month just goes up on YouTube, all right? The amount of viewership, over 1 billion people use YouTube, and that number is increasing every single year, all right? Also, the amount of times people watch YouTube is also going up, all right? For a lot of people like myself, honestly, I watch more YouTube, way more YouTube for entertainment purposes, educational purposes, anything across the board than I watch TV or anything like that. And I know a lot of people feel that same way, okay? Especially for the younger demographic. Now, as the younger demographic gets older, then we got a whole new generation that are also going to be using YouTube in the future, okay? So it's really going to continue to expand. And also advertising. The ad rates on YouTube are going to go up significantly over the next few years as more and more advertisers realize how good of a deal YouTube is. In my personal opinion, of anything that you consider social media or any big platform, YouTube has the cheapest ad rates you can possibly get. It is not going to stay that way. Ad rates are going to go up significantly over the next few years on YouTube, which is basically going to make, all the advertisers have to pay much steeper prices than they pay today, which is going to make Google's profitability for the YouTube side of their business great, because YouTube has lost money for Google for a long, long time. Now it is just starting to get to a place where it's going to start making money, and it's going to start making a lot of money for the company, okay? That's the first one. The second part of the business you got to think of is YouTube TV, all right? YouTube TV is a direct competitor to anybody in the cable space, okay? Anybody in the cable space, it is a direct competitor, and it's an indirect competitor to anything else where you might be spending your time, like a Hulu, a Netflix, Amazon Prime Video, anything like that. It's kind of an indirect competitor, but it's a direct competitor to anything that is a cable service, all right? And this is gonna be a business that really takes off. You can see the way YouTube is spending money to advertise this business, that they see huge potential here, okay? That's the next business. And the last business you got to really think about for the growth going forward for Google is their cloud business. They have a phenomenal business cloud product, and they have a phenomenal business to very small business or business to consumer, all right? We're talking about Google Drive. Google Drive is something that's used by many people that have very small businesses or just regular consumers in general who are looking for a cloud product, all right? They also have huge companies that are signed up for their major cloud products, okay? So those are the main things you got to kind of think about as far as Google as a growth company, and they should continue to grow. They're getting to be such a big company now that it's hard to really see the massive growth coming for the company, but those are 3 main products that over the next few years are going to continue to provide phenomenal growth for the company. Let's get into stock number 6. Stock number 6 is a stock that starts with an S, and this company has been a phenomenal grower. I remember it seems like just yesterday this was like a $20 or $30 stock, and now it's somewhere around 150. It starts with an S. Is it Snapchat? Heck no, it's not Snapchat. This stock is called Shopify, okay? Shopify. If you know anything about the drop shipping business and money people are making, it's phenomenal. By the way, if you're interested in drop shipping, after this video, check out my drop shipping for beginners video. I think that should help you out. But Shopify is the direct beneficiary of all this drop shipping business that has really taken off, okay? So whether it be you're trying to sell a product to somebody, let's think about it in this perspective, okay? Facebook is a social media platform that knows way too much information about you, right? They know so much information about you, it's insane. They give that information to their marketers, okay? These marketers can take that information and advertise products to you might be interested in, okay? So let's say you are really interested in German Shepherds. You always post about German Shepherds on Facebook or one of Facebook's social media. They own a lot of different social medias. You post about German Shepherds all the time, and you like German Shepherds, and you like, okay, great for you, okay? Someone could start a Shopify business, and they could strictly target people that like German Shepherds. And guess what they can do? When you're surfing down Facebook or Instagram or whatever you're on, okay, guess what's going to pop up? Oh, this German Shepherd calendar. Oh, this German Shepherd mug. Oh, this German Shepherd whatever, okay? All these different products, and guess what? You know, there's a much higher likelihood you're going to actually buy one of those products because you're very passionate about that, and you see this and you're like, oh, I love German Shepherds. Oh my gosh, I need to buy this German Shepherd calendar, okay? So that is a beautiful thing. Facebook, by the way, makes a ton of money off that because they're doing all the ads for that, and these Shopify sellers are making money off that in the end because they're selling the end product, okay? By the way, Alibaba's probably making a ton of money off that because a lot of these Shopify people use AliExpress, all right? Also think about it from the perspective of creators, whether it be on YouTube or any type of social media. You want to set up a store of some kind, it's probably good to set up a Shopify store, okay? Whether it be a merchandise store, anything across the board, it probably makes sense to probably do it on Shopify. They have great product, and it's generally pretty cheap. It's easy to set up, and so a lot of people end up using Shopify, and they collect their monthly revenue from all those different customers, and it's a business that has been losing money, might continue to lose business here or continue to lose profits in the short term, but over the long term, you can see the way this business is going up. It can probably be a very, very profitable business out into the future, guys. So that is why Shopify comes in at number 6. Let's get into number 7. The number 7 stock is a very, very tricky stock, okay? This stock looks right now like it doesn't have much growth going for it, okay? If you look at just the numbers on this stock, the revenue numbers, what's expected from analysts over the remainder of this year and whatnot, it looks like it's not a growth stock. It looks like it's just a lame stock, okay? However, this could be a very big growth stock. The thing with this stock is they grow in lump sums, okay? So 1 year their business is here, next year their business doubles, okay? It's that type, it's a home run type of business, not a single and double type of business. They hit home runs. And this company is literally changing the world, and they're a company named Cirrus Logic, okay? This is the only stock, I believe, on the list that I currently own, but Cirrus Logic is at the forefront of audio, voice, anything like that. The connected world is in terms of the audio side of it, okay? So think about you talk to your smartphone, there's microphones that pick up on that. They sell microphones, all right? Think about your smartphone or whatever device, has speakers and it plays, music out of it, or a voice or something that talks back to you. All those components, Cirrus Logic makes all those, okay? Those components, everything has to go through audio codecs and things. So guess who makes that? Cirrus Logic. They're the most focused company by far and away in the world, and focused on the voice game and the audio game, all right? And we're moving into a world where we're almost gonna expect everything to talk back to us, okay? I don't care what you're pretty much talking to. Think about, how many people have Alexas in their home now, okay? Amazon Alexa, or, the new Apple speaker, or a Google Home product or something. Think about that. Think about, if you talk about 5-10 years ago, all these people would have all these devices in their homes and they would be talking to them. You said, I don't know about that. That sounds a little crazy. That sounds like Jetsons or something like that. Cirrus Logic is a direct beneficiary of this whole move that we are moving into, where you expect to talk to everything and it just responds to you, okay? And it just knows what you're saying. I just talked to my camera, stop recording, and it stops recording something. This Canon 80D, it doesn't have that ability, but people are literally going to start expecting that into the future. You talk to everything, okay? And it gives you something back in return. They are at the forefront of that. They are literally changing the world in that perspective. As far as like the technology is amazing what they can do, okay? Whether you have your smartphone over there and you say, hey Siri, guess what chip that's going through? Cirrus Logic chips, okay? That ability where Siri knows that that's your actual voice talking, that's amazing stuff, guys. That's amazing stuff. Pretty special stuff. So that is Cirrus Logic there. Company changing the world in the audio and voice space. Let's get into number 8. The number 8 growth stock is another stock kind of like Cirrus Logic in their respect that it doesn't show major growth right now. They do have growth going for the company, okay? They do have growth going for the company right now, but I think they have a lot bigger growth going forward for this company, okay? And this company is named Skyworks Solutions, okay? Skyworks Solutions. And what this company does is they are a semiconductor company, okay? They're a semiconductor company, and if you look at the chip breakdown of any high-end Samsung phone or any high-end Apple phone or pretty much any smartphone out there, okay? You look at the teardown, you could literally type in iPhone 10 teardown, go look at the chip specs in that. What you're gonna see is a massive amount of Skyworks Solution chips, okay? Go look at the highest end Samsung phone. You're gonna see a bunch of Skyworks Solution chips, okay? Go look at a high-end Huawei phone or any Huawei phone. You're gonna see Skyworks Solution chips, all right? Skyworks Solutions is a company that is a very consistent company, okay? But they're a company that has proven that they can continue to get more and more content in smartphones, all right? So this is a company that used to only be able to get maybe $2 to $3 worth of content per phone, all right? Means if you buy an iPhone, Skyworks Solution would only make $2 to $3 off that. It's a company now that on some of the high-end smartphones, they're making 20 bucks, okay? 20 bucks, all right? 20 bucks for every iPhone sold or Samsung sold or whatnot. This company has been able to, you know, get a ton of content expansion. But here's the thing that's going to be going for Skyworks in the future, okay? It's a little thing we call 5G. They're one of the biggest direct beneficiaries of 5G and the way that's going to completely change smartphones, all right? And just networks in general. They're a company that is going to be able to provide some phenomenal chip solutions out there. Also, the fact that we're going into a connected world, which 5G is going to help, okay, where everything's connected, all these different devices are connected. Guess who's a beneficiary of that? Skyworks Solutions. Their connectivity chips are phenomenal. Some of the best in the world. Otherwise, Apple and Samsung and all these customers wouldn't be using them, okay? 5G can be a huge benefit as long as they execute, which this company has done nothing but execute phenomenally. As long as they can execute, this is a company that should be able to grow massively for the next 5 to 10 years, which is why they definitely need it to make the list. This next one coming in at number 9. Oh man, this next one is just a growth beast. Stock number 9 is an unbelievable company. I mean, I can make an argument that this company has executed better than anybody out there for the past 5 years. This company in the past 5 years, their stock is up 1,600% in a 5-year span. Yes, you heard me right. 1,600% in a 5-year span. This company has been so well run. They're executing on a visionary, and it's just unbelievable what this company can do. And they're a company named NVIDIA, okay? Phenomenal growth engine this company has, okay? So think about NVIDIA from anything from the perspective of high-end gaming. You know, you're probably using high-end NVIDIA chips, all right? Think about it from self-driving cars, or whether we're talking infotainment type products, NVIDIA chips, okay? Think about it from the perspective of anything that's going on in artificial intelligence. Guess who's the main dog who's kind of out in front of everybody in artificial intelligence? It is a company named NVIDIA, okay? Think about different cloud products and servers that need to use, you know, different types of chips. NVIDIA, okay? NVIDIA is in the forefront of so many companies, okay? Their GPUs are just like unbelievable, okay? They have gotten out in front of everybody, and the amount of market share they've been able to take from competitors and also just grow into the future is off the charts, guys. NVIDIA is an amazing company. They're starting to really rack in the profits now, and they're continuing to build out that business, the research and development. And NVIDIA is in a position now. This is an interesting thing about NVIDIA. They're in a position now that they don't even have to necessarily out-innovate the other players. They just have to stay with the competitors now because they're already out in front of everybody. So now all they have to do is just maintain and just, you know, kind of keep things even keel, and they will continue to win for the next 10 plus years, okay? Because they're that far out in front of everybody else in terms of the competition. It's been amazing what that company has done. The management in there deserves all the credit in the world. I mean, to have a stock perform like that, to have the revenue perform like that, the profits coming in the way they are, the belief in the company, the amount of they are changing the world, especially in the artificial intelligence wave, this company is right at the forefront of them all, guys. Unbelievable company. Nothing but good things to say about it, honestly. Nothing but good things to say about this company. And let's get into the last one, number 10. Stock number 10 is a phenomenal growth company, okay? Phenomenal growth company, and it's the only other direct Chinese company on the list, okay? All these other companies are actually American corporations, so this other one is a Chinese corporation. Phenomenal growth going for this company. It's a company named JD.com, okay? JD.com. They're a very different business model than Alibaba, okay? Alibaba, you know, they have a ton of different business lines, doing a ton of different things, and their main business line is their marketplace, all right? So they perform differently because Alibaba is really trying to, they're trying to help all these sellers, right? JD.com is more of a direct retailer, okay? So think about JD.com as what Walmart can kind of represent in the United States as far as, you know, retail goes. JD.com kind of represents that, but more on the online side, okay? Where Walmart, you think about physical retail. JD.com, think about them as the online platform, but they are a direct retailer, okay? Where they're actually running inventory and whatnot, and they have unbelievable supply chain. Everything I've looked into ever about China and supply chain basically says that JD.com is out in front of everybody in the supply chain wave, and so that's one of the huge competitive advantage is now they just have a lot of scale behind them. As a direct retailer, which JD.com is, as a direct retailer, once you get scale, you get buying power, all right? You get power over different third-party sellers and whatnot, because you can negotiate prices, better prices than other people will be willing to pay for and whatnot. So pretty impressive company, unbelievable growth. It should continue to have unbelievable growth. I would say probably my second or third favorite Chinese play. Okay, Alibaba's number one, and then I would say Tencent might be, and Tencent could have made this list also. I mean, if I had an 11 and wanted to include another Chinese company, I could have thrown Tencent on there. I won't even get into Tencent. They own so many businesses, and they have so many investments in so many different things. Unbelievable. If you ever looked into Tencent, it's crazy. But those are the 10 high growth stocks. Let me know which of these 10 you think I should buy. I would love to hear from you guys in that comment section. I'm looking forward to kind of building out that portfolio. It's going to be a lot of fun. By the way, if you want to get in my private stock market membership group, the rest of July, it is half price, guys. You enter that code half off at checkout. It will literally take the half off the price, not only of the first month, but every single month after that. I can't wait to see you guys in there. It's a lot of fun. You get to learn from me and just have a good time. So thank you for watching. Have a great day.
So with all the volatility in the market right now, it can be really nice to own some dividend stocks that actually pay you cash even when the market is struggling. And many of these companies have not only been paying dividends, but they've actually been increasing these dividends for many years, even through recessions. Speaking of which, many people are screaming that a market crash is just right around the corner. And as a long-term investor, that's not really something that I lose sleep over. I'm still constantly investing in stocks. But if we do get a market crash, a lot of these stocks are actually going to be trading at much lower prices. And what happens with dividend stocks is that when the price goes down, the dividend yield actually goes up. And a lot of these stocks already have very attractive dividend yields, not to mention pretty attractive prices too with all the market volatility. But if we get that market crash, you could probably pick up some even better deals on some of these dividend stocks at really great prices with really high yields. So today I thought it'd be fun to take a look at some dividend stocks that I'm either currently investing in or that I'm currently tracking. Also some stocks that you guys have mentioned in the comment section as well. But just a quick disclaimer, I'm more of a dividend growth investor, which means that my stocks tend to have lower dividends. So their yields are usually between like 1 to 3%. I actually like some other stocks too that have actually lower yields than that like lower than 1%. A couple that come to mind is like Nvidia, Activision, things like that, but I did not include those in this video. And I know that some of you are dividend income investors, so I included some stocks with higher yields as well so that you don't feel left out. So there's gonna be a lot of variety in this video. One more thing, I like to invest, when looking at dividends, I like to invest in very strong companies with very strong brands that have been around for a while and that are likely to not disappear in the future, because I want to continue to receive those dividends in the future. So a lot of these companies will be very popular. You've probably heard of all of them. So I apologize if you wanted some more risky, companies and stocks that you've never heard of that pay really high yields of like 7%, 8%, things like that. But a lot of those tend to be a lot riskier and their share price is usually trending downward. So I usually stay away from those. So I apologize if that's what you wanted, but either way, I do think that this will be a very fun video. We're going to take a look at a lot of stocks and I hope you enjoy this. If you do, make sure you hit the like button and stay tuned. Let's go ahead and get started. What's up everybody, my name is Ale and welcome to my world of stocks. So the way we're going to do this today is we're going to take a look at 8 different dividend stocks. I actually wanted to do 10, I wanted to do even more, but the video would just be way too long. So we're going to do 8 stocks. We're going to take a look at their dividends, their price performance, and I may even give a couple reasons why I like the company as well, because that's also very important. And then at the end of the video, I'm also going to include some honorable mentions because I wanted this video to actually be longer, but I didn't want to make it too long. I didn't want to bore you guys. So anyway, with all that said, let's go ahead and get started. Okay, starting with stock number 8, we've got PepsiCo, ticker symbol PEP or just PEP. This is the company that owns Pepsi. They also own very big brands like Gatorade, Mountain Dew, Aquafina, Tropicana, Naked Juice, Rockstar, and even some non-beverage brands like Quaker and Frito-Lay, which includes Lay's, Doritos, Cheetos, Tostitos, Fritos, and Ruffles. And looking at their price performance, they've been pretty steady in the past 5 years, but are only up around 30%. But in the past decade, their performance improves to over 150%. Still, PepsiCo isn't really recognized for its future growth as much as its stability and reliable dividends, and luckily, they deliver in both of those departments. In fact, they currently have a dividend yield of over 3%, paying $3.71 per share, and they have an absolutely massive growth history of increasing their dividends every single year for the past 46 years. That is massive. And while their 5-year growth rate is only in the single digits, I still consider it reasonable at over 8%, and their payout ratio isn't too bad either at 65%, although I typically like it to be lower than 50%. Now, I've never invested in PepsiCo myself because I've been worried about consumers moving away from sugar and artificial sweeteners, and I'm also more of a growth investor, and PepsiCo doesn't really fit my specific criteria. In fact, they've only grown revenue by a couple percent last quarter, but on the other hand, EPS did grow by almost 20%, and they've been making moves to diversify their options to include healthier alternatives like juices, waters, things like that. They also include smaller portions, and on top of that, in my opinion, they made a very good acquisition in SodaStream. So they acquired SodaStream, which sells products that let you convert water at home to carbonated beverages. And SodaStream actually saw their revenue jump by over 30%, and net income jumped by over 80% in their last quarter that they reported. So this new acquisition may help PepsiCo enter a new market, which is kind of the home, kind of creating a carbonated beverage market. So that lets them enter a new market, and because SodaStream has been performing so well already, now that they're getting backed by a huge corporation like PepsiCo, I think they're just going to continue to have even more success in the future. So, with those really nice dividends that PepsiCo is already paying out, I think PepsiCo is actually looking pretty attractive right now. Okay, moving on to stock number 7, we've got my second largest stock in my entire portfolio. This is a stock that I am extremely bullish on, and that is Microsoft, ticker symbol MSFT. And I should clarify, bullish in the long term, because anything can happen short term. And I know a lot of people will get very angry at me if any of these stocks kind of drop in the short term, but long term, Microsoft, such a good company. Now, their dividend is very low at less than 2%, but they fit every criteria to be in my dividend growth portfolio, with a 5-year growth rate in the double digits at almost 14%, and their dividends are likely to continue to increase in the future thanks to a strong history of 15 years of growth and a low payout ratio at less than 50% at around 41% to be specific. On top of that, this has been one of the most reliable stocks out there, being up over 22% year to date, over 173% in the past 5 years, and they currently trade for around $100 per share. Now, Microsoft really needs no introduction, but some of the reasons why I'm invested in them include their cloud segment with Microsoft Azure, which is the second largest cloud platform in the world, only behind Amazon's AWS. They dominate the PC market with the biggest operating system in Windows. They offer tons of business solutions with Office 365. Many of their apps and services are also available on smartphones. They dominate the PC gaming market with Windows, and they compete heavily in the console gaming market with Xbox. They're even using Azure to stream video games out to your cell phone with Project xCloud, which should be launching, I think, sometime next year. So a lot of analysts are actually calling Microsoft the next Netflix of gaming. We'll have to see if that plays out, but that is something to look forward to. And they even made some big acquisitions of LinkedIn for the professional networking market and GitHub for the coding and developer market. Not to mention that they even do a lot of work in artificial intelligence, augmented reality, and autonomous driving, which Microsoft Azure, some people pronounce it Azure, or Azure, I think, but I like to say Azure. It's actually being utilized again as the base for cloud and connected car services, which will be used by Volkswagen in over 5 million cars starting in 2020. So there's actually a lot of synergy within the company and their different products and services, with Microsoft Azure being a prime example of that. And this is a company that is really on fire. When looking at their results, their last quarter, revenue was up 19%, net income was up 34%, and EPS was up 36%, while almost all of their different products and services saw enormous growth, including Microsoft Azure up a massive 76%, Gaming and Xbox was up 44% and 36% respectively, and LinkedIn was up 33%, and Office 365 Commercial was up another 36%. So even though their yield is pretty low, this is a company that again is absolutely on fire, is already dominating in several different markets, and is still making acquisitions to dominate in new markets as well and keep that growth moving forward. So as a dividend growth stock, Microsoft absolutely fits the bill. All right, guys, moving on to stock number 6, we've got McDonald's, ticker symbol MCD. Now, this is a company, very interesting company, because I've actually never really been too bullish on McDonald's. I've always been scared about, people moving towards a more health conscious future and staying away from a lot of these junk food places. But so far, I have been completely wrong on McDonald's. I mean, they've performed very well. And I know that a lot of my viewers really like McDonald's. So that's why I included it in this list today, because a lot of my viewers are actually invested in McDonald's and they always want me to talk about it. Now, when looking at their price performance, they've almost doubled in the past 5 years. And despite recent volatility in the market, they're still up over 6% year to date. And so they're currently trading close to their 52-week high at over $180 per share. Now, when looking at their dividends, they have a decent yield of over 2.5%, a reasonable payout ratio at under 60%, a pretty low 5-year growth rate of only around 6%, but an absolutely massive growth history of over 40 years, at 42 years to be exact. And the reason why McDonald's has had this really long growth history for those dividends is because the company has just performed very well. You know, when you look at the fast food market, McDonald's is just one of the most recognized brands out there. I think it's going to be very hard to find anybody who hasn't heard of McDonald's, if not impossible. So McDonald's is just this really strong brand that has been dominating for a very long time, yet they're still seeing a little bit of growth as well. In fact, in their latest quarter, global comparable sales increased by over 4% at 4.2%, which actually beat the industry average of 3.5%. And they saw positive comp sales in all of their different segments. And thanks to new innovations that McDonald's is investing billions of dollars in to modernize their restaurants with delivery options, digital ordering features, and their whole new concept and design called Experience of the Future, Mickey D's is likely to see that growth continue. Now, their new digital ordering kiosks may attract some younger customers to their restaurants, but even if they don't, their new mobile app may help increase orders. In fact, they have over 37,000 restaurants, so that very large footprint for McDonald's makes it ideal for delivery services through partnerships like the one that they already made with Uber Eats, and it gives them an overall advantage over their competition. Still, McDonald's is not really a company that fits my overall investing strategy, because I like to invest in stocks that or companies that I actually use their product, or that I at least like their product, and I don't really feel that connection with McDonald's. But McDonald's is a company that continues to prove me wrong, continues to perform well, and those dividends are actually pretty darn attractive. Okay, moving on to stock number 5. We've got a company that I've never personally invested in, but it's a stock that a lot of you guys have mentioned to me that you're invested in and that you've wanted me to talk about, and that is Verizon, the telecom giant, ticker symbol VZ. Now, their yield is pretty high at over 4%, and they have 14 years of growing those dividends every single year. And when you combine that with a pretty reasonable payout ratio at just barely over 50%, you essentially get a pretty reliable dividend that isn't likely to disappear anytime soon. However, their 5-year growth rate is too low for a dividend growth investor like myself at less than 3%. But taking a look at their stock price for the past 5 years, they've been kind of all over the place, but thanks to a recent rally in 2018, they've managed to finish up 16% in the past 5 years and up almost 9% year to date, currently trading for around $57 per share. And one of the reasons for that rally has to do with their performance. It's actually been pretty decent. Now, don't get me wrong, this is another slow growing company that increased revenues by only 2.8% year over year in their latest quarter. But thanks to tax reform, their EPS grew almost 25%. But more importantly, their free cash flow actually grew from $5 billion to $14 billion year to date and year over year. I know that's a little confusing, but just know that it increased by a lot. And the only reason why it isn't higher is because they've been investing so much money on their new 5G infrastructure, which is going to be a key component to their growth moving forward. Now, despite that recent rally, they're still pretty cheap with a PE ratio of only around 7. So in Verizon, I think you get the leading telecom in the country that doesn't necessarily have enough growth to attract an investor like myself. But for dividend income investors or value investors, this is a very stable company with over 116 million wireless subscribers that operates in a market that isn't going to disappear anytime soon when you consider how addicted we all are to our smartphones. And because they're already first to market with 5G networks available in LA, Sacramento, Houston, and Indianapolis, Verizon is in a good position to keep those subscribers and add to that number thanks to markets that are set to explode like the Internet of Things and autonomous driving. Having said that, I kind of like AT&T a little bit more just because they've acquired Time Warner to compete with Netflix and Amazon in the video on demand market. And they also have a higher yield of over 6.6% with a massive 34 years of dividend growth. And they even have a cheaper PE ratio of less than 6. But I already talked about AT&T in last week's video, and a lot of people left comments saying that they preferred Verizon over AT&T. So I decided to just include Verizon in this video. But either way, both telecom giants are absolutely on my radar, especially if they drop in price sometime in 2019, any kind of major event. They would look very attractive to me, especially with those really high yields increasing even higher. Okay, moving on to stock number 4, we've got Apple, ticker symbol AAPL. I know that's a little bit of a shocker. I feel like nobody ever talks about Apple's dividends because their yield is pretty low. We'll take a look at it in a second. But Apple is actually a pretty good dividend stock. And when you consider the fact that Apple has dropped so much in price recently, it's starting to look even more attractive. Now, they currently have a pretty low yield of less than 2%, but as a dividend growth investor, they look very attractive with a really low payout ratio of just a little over 20%. And their 5-year growth rate looks just as good, barely over 26%. However, they've only grown those dividends for 6 years, so the history could be better, but the low payout ratio and high growth rate tells me that it'll probably continue to go up over time. And thanks to the recent drop in price, Apple isn't even that expensive. This is Apple that we're talking about, and they have a forward PE of only 11. That's pretty crazy. And despite climbing over 100% in the past 5 years, they recently dropped by close to 30% from their recent high, which may represent a good entry point. Now, the reason for that drop has to do with their future iPhone sales looking weak. In fact, despite having an outstanding fiscal fourth quarter with revenue up 20%, EPS up 41%, iPhone revenue up almost 30%, and services up 17%, their stock still dropped because they announced weaker guidance than expected. iPhone unit sales were up less than 1%, and they announced that they won't be reporting unit sales for iPhones, iPads, and Macs going forward, which led investors to panic that sales are going to get dramatically worse in the future. Now, much of that was speculation until an Apple supplier named Cirrus Logic came out and lowered their guidance. Now, this is an audio chip maker that received over 80% of its revenue from Apple in fiscal 2018, and they lowered their revenue guidance by over 15%. So that definitely led investors to think that Apple's iPhone sales will be even slower than expected. Still, their services segment brought in $37 billion in their fiscal 2018, and analysts estimate that it'll be worth over $50 billion by 2020. And the reason why their services business is so important is because it keeps customers invested in the Apple ecosystem and drives product sales even further. Apple is also reportedly working on autonomous driving software and a new video on demand service, which could be potential growth catalysts in the future. Not to mention that Warren Buffett's Berkshire Hathaway owns a $46 billion stake in the company, and they recently revealed that they bought more Apple stock in the third quarter. So with Apple, I think that you get a pretty nice dividend that is set to grow even further in the future. However, I do also think that iPhone sales will probably slow down at least until 5G comes out, and that might not come out until maybe late 2019, 2020. And because iPhones are just so expensive as it is, I don't see a lot of reasons for customers to actually upgrade their iPhones when Android phones are actually so much cheaper. You know, I personally have a OnePlus 5, and I think it cost me like $500 around there. So about half the price of some of these $1,000 iPhones. And my OnePlus 5 has like 8 gigs of RAM, and it has a really good processor, so it's just a really good phone. So I just don't see a lot of people willing to upgrade their iPhones until 5G comes out. That could be a potential catalyst to get people to upgrade. I'm not saying iPhones are bad. From what I hear, iPhones are absolutely great, and I think people will stick with iPhone. I'm just not sure that they will upgrade every single year until something comes out like 5G, but we'll have to wait and see. Either way, I think a lot of this negativity is already being priced into Apple stock. And even though I'm not invested in Apple myself, if we have another couple bad quarters for Apple, we kind of see some sales kind of slow down or something like that, and the stock gets dragged down even more, I don't think I'd be able to resist. I'd probably be looking to jump into Apple stock myself. All right, guys, moving on to stock number 3, we've got United Health Group, ticker symbol UNH. Now, this is another stock that I'm not currently invested in yet, but I'm very bullish on this stock. And the only reason I haven't bought it yet is because I think it's a little expensive. But if it were to drop a little bit in price, if I see a good entry point, I'm definitely buying this stock because it's one that I've definitely had my eye on for a while now. In fact, I recently talked about them in my 3 stocks to buy video for December, and since making that video, the stock climbed by over 3% in that very short time span, but it's currently trading at around $269 per share. Now, their dividend yield is pretty low at only around 1.3%, but they have a decade of dividend growth with almost a 30% 5-year growth rate that is very impressive, and an equally impressive payout ratio of just 28%. So these dividends are very likely to grow in the future. And when looking at their stock price, this is a stock that has performed very well and has been very stable over time. It's up over 260% in the last 5 years and up over 22% in 2018 alone. And a major reason for that is because of the type of business that they have. They offer healthcare related services to payers, care providers, companies, employers, and even the government. And on top of offering healthcare plans and pharmacy services, they've also invested billions of dollars a year to build up their healthcare related technology that even goes as far as to use artificial intelligence, machine learning, and blockchain technology to improve both the efficiency and the security of their healthcare related services and associated big data. On top of that, this is a company that is firing on all cylinders, having gained an additional 2.8 million more customers year over year this past quarter, and it grew to almost 50 million people total. They also saw revenue increase by double digits at almost 13%, and EPS was up another 28%. So with record low unemployment leading to more companies offering healthcare plans to their employees and an aging baby boomer population, I think United Health Group is definitely a stock to watch, not just in 2019, but beyond that, and it's a very good dividend stock as well. Okay, next up, we've got stock number 2, and this is a stock that I am currently invested in, and this is a semiconductor stock. And the thing about these semiconductor stocks, it can be a little risky sometimes, these risky kind of tech stocks, they can be a little cyclical as well. And whenever we have market volatility, whenever we have a kind of market crash, things like that, these kind of stocks get absolutely hammered. So if you see a stock like this get hammered, you may want to consider it. And if this stock drops significantly in price, I will definitely be unloading a truck on it in the near future. But this company is called Taiwan Semiconductor, and their ticker symbol is TSM. Now, despite being a dividend growth stock, their dividend yield is actually really nice at over 3.5%. Their payout ratio is a little high at 60%, but their 5-year growth rate is really good at 18%. But they do only have 4 years of growth, but that's because they just started paying those dividends recently in 2013. Now, when looking at their share price, this is a stock that was performing very well, up over 100% in the last 5 years, but they took a plunge in 2018, mostly because they do a lot of their business in China and investors got spooked because of the whole trade fight that's going on. So the stock is actually down over 20% from their 52-week high. On top of that, TSM makes the processing chips for Apple's iPhones, and with slower smartphone growth being projected, that is only hurting TSM in the short term. Now, I should probably say what kind of a company this is. So this is a foundry, so they manufacture these semiconductor chips. Now, all of this short-term negativity may actually end up being a good opportunity for you if you're a long-term investor. See, TSM is the first foundry to manufacture the 7nm chips that are actually going to be used for AMD, which everyone is going so crazy over. On top of that, TSM is already working on 5nm chips that could be ready as early as 2020, so they're likely to be well ahead of any competition when it's all said and done. Keep in mind that Intel is still operating at 14nm and is barely going to be pushing out 10nm sometime in 2019, with their 10nm server chips pushed even further to 2020, which leaves plenty of room for AMD's chips built on TSM's 7nm technology to steal market share away from Intel. And as far as the trade fight goes, that may bring down the stock a little bit further in the short term, but I do think that this is something that gets solved eventually and we move past it. And even looking at TSM's CEO, he had this to say about the whole deal. He said, for the short term, we did not see any impact, if there's any at all. So our China customers, no, they did not change their behavior. TSMC has been proud to be everybody's foundry. So if there's trade tension and if it continues, the impact to TSMC would be less or minimized. Either way, like I said, I think a lot of this negativity drags the stock down even more in the short term, but as a long-term investor, you know, if I'm looking at these lower prices, I'm definitely picking up more TSM stock in the near future. I think it's a really good dividend growth stock with that 7nm and even 5nm technology in the future being potential growth catalysts as well. Okay, and finally guys, we've got stock number 1, and this is actually my number 1 largest stock in my entire portfolio. I could not be any more bullish on this stock. I love this stock as a long-term investment. I have so much confidence in this stock and I really want to pick up more. On any dips, I'm constantly buying more of this stock, and that company is Disney. Their ticker symbol is DIS. Now their yield is very low at just over 1.5%, but they have almost a decade of growth, a 5-year growth rate in the double digits at over 16%, and a very low payout ratio of less than 25%. So this dividend is likely to increase more in the future. Now looking at their share price, I feel that this is a stock that is valued at a very good price in my opinion. Yes, they're up over 50% in the past 5 years, but they're only up less than 5% in 2018 thanks to all of this market volatility, and their PE ratio is very low at only 13. Compare that to their soon-to-be competitor in Netflix, who is trading at a PE ratio of almost 100. That is an insanely large gap. And the reason I mention Netflix is because despite Disney having so much more to their business, including world-class resorts, theme parks, and a massive movie studio, they're now planning to tackle Netflix in the video on demand market with their new Disney branded service called Disney Plus that will feature Star Wars, Marvel, and other Disney branded content. On top of that, they have an enormous pool of content and IP that they acquired from 21st Century Fox to bolster their Hulu and Disney Plus platforms with even more options for consumers. And when looking at their most recent quarter, Disney reported revenues up 12%, net income up 33%, and EPS up 37%, even beating analyst estimates. So this is a company that is already performing very well right now, and with the recent acquisition of those Fox assets, they're going to be tackling Netflix in that market. I know I'm definitely signing up for that Disney Plus service because I love Star Wars, I love Marvel, and I know there's a lot of people out there that love that content as well. Not to mention everybody that has kids that will want all the Disney branded stuff. And not to mention that there's also Hulu as well. And Hulu is actually seeing some growth as well. I got into Hulu in some other videos. But anyway, with all that being said, I think Disney is a really good company that is performing well. And they also have a very nice dividend to go along with it. Okay, guys, now before we finish the video, I do just want to give some honorable mentions, starting with IBM. So their ticker symbol is IBM. They have a yield of over 5%, a good payout ratio of 45%, double-digit 5-year growth rate at over 12%, and 19 years of growth. They also just recently acquired Red Hat, which makes them a pretty interesting stock to look into, and I think I'm actually going to make a video on them in a couple days, so make sure you're subscribed for that video. Kraft Heinz is up next. They have a very nice yield at over 5% and a 5-year growth rate of 37%, but a high payout ratio of almost 70% and only 6 years of growth. And their stock performance could be a little bit better as well. Starbucks is up next. They have a reasonable yield at above 2%, a reasonable payout ratio of 54%, very good 5-year growth rate at over 23%, and almost a decade of growth. Okay, next up here we have Coca-Cola. So I talked about Pepsi earlier. Here is their rival Coca-Cola. They have a very nice yield at above 3% and a massive growth history of 56 years of growing those dividends. But their 5-year growth rate is a little low at 7.7%, and their payout ratio is pretty high at almost 75%. And honestly, I just really like PepsiCo a lot more than Coca-Cola, and I think they're a little bit better diversified as well. Okay, next up here we have International Paper. I recently talked about them in one of my videos. Their ticker symbol is IP, and they have a very nice yield of almost 4.5%. They have a good payout ratio of 37%, double-digit 5-year growth rate at above 11%, and 8 years of growth. And the reason why I like IP is because they're really being hammered by the whole trade fight with China. But if that trade fight ever gets resolved, I think IP will be a really good stock to own. So I kind of like them at these prices. And then finally, we have the very controversial Ford stock, but I couldn't make this video without mentioning them because so many people leave comments about Ford stock. They have a massive yield of almost 7%, a good payout ratio of about 45%, a great 5-year growth rate of over 25%, and 6 years of growth. I personally have no interest in investing in Ford. I don't really believe in them, but their dividend is pretty nice, and a lot of people leave comments about them, but it's not a stock that I would recommend to anybody, not really a stock that I believe in. Okay, guys, I think that just about does it. I don't mean to sound so bearish on Ford. I know some people are very bullish on it. Just personally not a stock for me. Anyway, I hope that you enjoyed the video, and if I left any stocks out that you wanted to be mentioned, make sure you let me know in the comment section. Maybe I can make another video a little bit later in the future, and I can include some more stocks that maybe you guys mentioned, and I can give my opinions on them and things like that. But if you'd like to see that, make sure you hit the like button. And if you want to support the channel, all I ask is that you hit that like button. It really helps me out more than you could ever know. And I really appreciate all the support, guys. Thank you for watching. I hope you all have a wonderful, beautiful day and that you take care. Bye-bye.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.
In 1990, Peter Lynch retired as manager of Fidelity Magellan, the nation's largest stock mutual fund, and one of the most successful. In 13 years, he drove Magellan to a 2,800% gain. Quite simply, Lynch has been recognized as one of the greatest money managers ever. He beat the stock market for so long not by timing the market, but by picking the right stocks. Of course, no one can promise you Peter's record, but you can learn a lot from him. And you don't need a billion-dollar portfolio to follow his rules.
Hi, my name is Peter Lynch. For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more. I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has. In Stock Shop, I'm here to help you find them and use them. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year, Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000. Go ahead and play with the numbers yourself.
If you clicked on the Assumptions button on the previous interactive screens, you noticed that the worksheets do not take taxes into account. When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, KEOs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks. This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you're going to do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down? In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Many people ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow.
Your advantage in picking stocks is your direct experience with companies as a consumer, on your job as a professional, or as a neighbor. Use those advantages as a place to start looking for good stocks.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products. You see some services that are terrific. We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash. You're paying almost nothing for the company. They had lots of other divisions that were doing terrific.
Buying that car turned out to be a great way to begin researching the stock.
Sometimes people take things for granted. My field was the mutual fund industry. In the early 1970s, the industry grew slowly, but then it took off in the 80s. Money piled in to money market funds, to equity funds. Like an idiot, I missed stocks like Dreyfus, Pioneer, T. Rowe Price, Strategic Investments, Franklin Resources. There was lots of companies that went up dramatically. These are my own field. All I had to do was buy these things. It was really dumb.
Back in the 1950s, a fireman from New England noticed a factory in his town seemed to be hiring and expanding all of the time. This person didn't have a Cray computer, and he wasn't a professional investor. He was just an observant neighbor. He decided to put $2,000 per year into TAM brands, then called TAM Packs. By 1972, the fireman was a millionaire, just from using his local edge.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain. It's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
If you know something that will drive a company's earnings higher, you know something that will drive a company's stock higher, sooner or later. But you can't just guess at it. You have to have some reasons. such as costs are coming down or a new product's going to be a big hit. Research is developing a company story, an idea of why earnings should go up or down. It doesn't mean sitting in the library for hours, reading SEC filings, or fiddling with a calculator.
Research is exciting. It's very little math. When I owned Chrysler, it was the biggest position in my fund. When I was at a movie theater, at a sports event, I'd run into somebody driving a minivan. I'd ask them, what do you think of the minivan? Would you buy another one? What do you like about it? Some would say, well, it's a little underpowered. They only have a 4-cylinder engine. I knew they were already working on a 6-cylinder engine. So this is research.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job. I owned Dunkin' Donuts for 12 years. I think I might have talked to them once every year. The story didn't change a lot. You don't have to worry about low-cost imports coming from Korea when you own a donut company. You don't have to worry about the economy. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they had just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu, they kept their costs low, they added breakfast, they went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. Lots of good companies had nothing to do with wars, nothing to do with banking. They all went down in 1990. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. This is a company that's had 35 years of double-digit earnings growth every single quarter. We've had changes in the Supreme Court. We've had the stock market go up and down. We've had changes in presidents. We've had recessions. We've had wars. All of those things had no effect on automatic data processing. So every time the market went down, it gave you a chance to buy it. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam.
Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount. If you start by looking at the entire universe of stocks, more than 3,000 stocks on the New York Stock Exchange alone, and over 13,000 public companies in total, you'll blow a gasket. So I break stocks into categories, partly to make the job of researching more manageable. Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company. You simply can't expect all stocks to behave the same. Basing a strategy on general maxims, like sell when you double your money, or sell when the price falls 10%, is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches, different expectations, and different kinds of stories. Suppose you've made a 50% gain on two companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return could be just the tip of the iceberg for the fast grower. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds. At the end of this presentation, you'll have an opportunity to explore each category in more detail. In the meantime, remember, categories are guidelines. They are not hard rules. Some companies may not fit neatly into a category. Others may seem to be in 2 categories at once. Almost all companies change categories at some time throughout their lifetimes. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclicals experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclicals again. Use the categories as guides to help you build your story, but don't let them limit the questions you ask or the research you do. One thing we can say about companies in general: it's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings. As well, good opportunities exist in companies that are cyclical, regardless of their size. When most people think about investing in the stock market, they dream about investing in a fast grower, a company that is growing at over 25% a year. At 25% a year, a company's profits will double in 3. They quadruple in 6. They go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off. The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money. What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing. One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to. Microsoft was a company you could have bought 3 years after it went public and made over 20 times your money. Sales and earnings were growing at several times the rate of the companies in the S&P 500 in an industry that was exploding by leaps and bounds. And it had a lot of potential both overseas and domestically. This was only the beginning of a 15 to 20 year growth cycle. You had plenty of time to get involved. There was this amazing company called Superior Industries. I think the stock went up over 100-fold. They were very good at making aluminum wheels. A lot of car companies went to aluminum wheels. The industry for autos wasn't growing. Aluminum wheels were growing dramatically, and they were the best at it. The fast growers get all the attention in the media. But there's nothing wrong with slow-growing stock, provided you get it at a very decent price. Somebody would say to you, I'm going to sell you a business for $100,000, and they're earning $50,000 a year.
You say, what's the bad news? Let's say the bad news is earnings are never going to grow. They earn $50,000 a year forever. So this is a price earnings multiple of 2. You pay $100,000 for $50,000 of earnings, but they're never going to grow. You say, I don't care. I'm going to get a $50,000 return every year. In 2 years, I get all my money back, and then I'm going to make $50,000 a year on my $100,000 investment forever. So sometimes, even if a company has a very low growth rate in earnings, if the stock is selling at the right price, it may still be a very good deal.
A slow to moderate grower will have earnings growth of 3 to 15% a year. One company that I was very lucky with was Service Corp International. It's a funeral home company that bought up local family funeral homes, a very steady business. Service Corp could grow earnings at 15% a year when I owned it with very little problems. A slow grower that turns into a no-grower is a very bad news situation. So when you start researching the stock, look for these signs. Steady earnings growth. You can find annual earnings growth rates in the research section, as well as estimates for the coming year. Rising dividends. Companies that raise their dividends each year have to have the earnings to do so. A rising dividend is normally a good sign for a stock. Room to keep growing. You want slow growers to go on forever. That's one reason I like Service Corp International so much. This was a great stock for me in the 1980s. At that point, it had a long way to go. Cyclical companies rise and fall with the economy. Typically, they make expensive big-ticket items that people buy when the economy is good. Things like houses, cars, and furniture. When the economy is bad and people are worried about losing their jobs, they don't buy big-ticket items. They're too broke or too scared that they will go broke. Don't try to time a cyclical stock if you don't have intimate knowledge of the business, if you don't have an investor's edge. Everyone on Wall Street tries to time cyclical stocks too. Because the stock market looks forward, you could be left with a sinking stock even though the company's earnings are terrific. You make your best money in a cyclical when earnings go from rotten to mediocre, or from mediocre to pretty good. The danger point is when earnings go from great to spectacular. Somewhere between these 2 points, Wall Street will figure out there's only one way to go, and that's for profits to go down some point in the future.
Just don't buy in the hope. Wait for things to get better. Prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big.
Let's take a look at Chrysler. In 1990, the company was selling for $10 a share. The economy was lousy. People were talking about Chrysler going out of business. But guess what? The economy came back. Everyone's old car was falling apart. As people made more money, they started buying new cars. And because Chrysler had great products, the minivan, the Jeep, and its first new full-size truck in 20 years, the stock was big. And in addition, very importantly, the balance sheet was decent in 1990. This was not a company about to go bankrupt.
If it's a cyclical, you're hoping for a dramatic turnaround in earnings. It's going to happen over 2 or 3 years. Earnings are going to go from a loss to a huge profit. Stock's going to go up and you're going to get out.
Make sure you're picking a strong company that can survive when the cycle goes down. That means good cash flow and low debt. If its cash flow is spotty or its debt is high, when the downturn comes, the company faces the danger of going bankrupt. Turnarounds. These are stocks that are battered down, or they're hated companies, or they've been forgotten about. They're depressed in price. But you have determined some one thing or a few things that have the potential for reversing this company's fortunes, independent of the industry getting better or the economy getting better. You always have to do a balance sheet check on any company. This includes turnarounds. Do they have enough cash to make it through the next 12 months, the next 24 months? Do they have a lot of debt that's due right now? These are important questions to answer. Make sure you understand and believe in the plan to restore corporate profits.
It's all internal. They're doing something, either new product, new management, cutting costs, getting rid of something inside the company that allows them to improve themselves.
Lots of turnarounds never happen, but a few winners can make up for lots of losers. What's important is to wait for the actual evidence of the turnaround occurring, not just the symptoms.
The turnaround, you had plenty of time. So just don't buy on the hope. Wait for the reality. Turnarounds are so big, it's worth waiting to get some real evidence. S.S. Kresge was a company going nowhere, in real trouble. They invented the Kmart formula. They rolled it out across the country. The stock went up over 50-fold. Kmart became a massive stock.
Sometimes 2 and 2 equals 8. How could this be? Because a company has a hidden asset that isn't reflected in the stock price. When Wall Street wakes up to the hidden assets, the stock could be terrific. Want a great example? Let's look at Disney.
Walt Disney is an example of an asset play. After they'd opened up Disney World and after they'd opened up Epcot, the company's growth rate sort of slowed down. They weren't growing very fast. And then they discovered there was a lot of assets inside the company. There was the name Walt Disney. They started the Disney Channel. They started selling things that they sold at Disney World and at Disneyland. They started selling them everywhere. They used their licenses for Mickey Mouse and all their characters. Made a fortune on that. These were on the books for nothing. The company was loaded with assets. In addition, they had all that land inside of Disney World, and everybody had hotels outside of Disney World. They decided to use their land inside to develop more parks, and then even have other companies come in. These companies paid their money to build inside of Epcot or inside of areas of Disney World.
So what are hidden assets? Many companies, particularly old-line companies that have been around 20, 40, 50, 100 years or more, have real estate holdings whose true market value is not reflected on the balance sheet in the annual report. In many cases, the hidden asset is the company's name and its reputation. Disney is one example of a company with a great name. So is Coca-Cola. That name can be a huge asset when the company rolls out a new product. This name is carried at little or no value on the balance sheet, whereas it is incredibly valuable. Companies like Intel and AT&T not only make great products, but they have numerous patents for these great products. As long as they have those patents, no one can make the exact same product. That's a tremendous aid in any business. Back in 1987, when the stock market had a major correction, Dreyfus fell to below its price of cash per share. Stock fell from over 50 to under 20. At that point, it was selling for less than its cash. Anytime you buy a stock at less than its cash after subtracting all debt and it has good business, you're getting something for nothing.
The price of a stock will follow the direction of earnings. In almost every case, you can generally state that if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically.
Even if you have a Waterford crystal ball, you probably can't predict a company's earnings. But Wall Street has a whole army of people who make such predictions. By computer, you can get Wall Street earnings estimates in the research section of the stock shop or through many other online services. Or you can go to your local library and find earnings estimates in Value Line or Standard & Poor's. Obviously, you want to invest in companies whose earnings are expected to rise. But again, these are just estimates. If you really understand a company, you should know how it plans to make earnings rise. If you know it has good growth prospects, then you'll be better able to evaluate the company as an investment. You can't predict the future, but you can learn from the past. A company with a long history of earnings increases and dividend increases is obviously a stable performer that has a reasonable chance of continuing to perform well in the industry. Many times that's a good company to investigate further. Johnson & Johnson has raised its earnings something like 19 of the last 20 years. It's raised its dividend over 30 years in a row. But just because a company has had a great record in the past does not mean earnings will grow terrifically well in the future. You have to have reasons for it. Strong growth in research and development, cost-cutting, new products, great brand name, and a terrific balance sheet were the items that made me optimistic about Johnson & Johnson. And what's the outlook? It's going to keep continuing to grow. They run out of steam, stock's going to run out of steam.
Price-earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling at $100 a share and they're earning $10, there's a price-earnings multiple of 10. The P/E ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant.
Why look at P/E? It can tell you if you're paying too much for a stock. The higher the P/E, the more expensive the stock relative to the company's future earning power. The lower the P/E, the cheaper the stock. I use a rule of thumb to level out these differences. A fairly priced stock is a P/E that's about equal to the expected annual growth rate over the next 3 to 5 years. If the P/E is substantially higher than the growth rate, the stock is normally expensive. If the P/E is substantially lower, the stock is probably cheap. A stock P/E, in part, depends on the industry that it's in. when you look at a growth company, compare the company's growth rate and its own PE to that of the industry. All other things being equal, if you find a company with a much lower PE and a higher growth rate, you're off to a good start. You can also compare a company's PE to its own historical PE. If a company normally sells for 25 times earnings, and now it's selling at 15 or less, you have to ask yourself why. The company could be maturing, competition may be entering the field, and its growth prospects may be uncertain. But maybe it's simply been beaten down by some other factors, and it's possibly a bargain. It's worth researching. Back in the 1970s, Electronic Data Systems, or EDS, had a PE of 500 times earnings. If you had invested in a company with a PE this high when Columbus discovered America, and the company's earnings stayed constant, you'd just be breaking even today. In 1974, EDS performed very well, but its stock fell from 40 to 3, simply because the stock was so grossly overpriced relative to current earnings. Dividends are cash payments that companies make to shareholders, usually every quarter. Nearly half the return in the S&P 500 the past 50 years has come from dividends.
Dividends come from profits. If a company earns $5 a share, they have the choice of paying out some of it to the shareholders in the form of a cash dividend.
A stock's yield is the annual dividend payout divided by its current price. The yield is the return you get on your investment every year.
One drawback: the IRS considers dividends as income, so you have to pay taxes on dividends. Not all companies pay a dividend. Fast growers, for example, almost never pay a dividend. They reinvest all of their earnings back into the company. Slow growers tend to pay out profits and dividends. It's their way of rewarding shareholders. Over time, those dividends can add up.
Some people have bought stocks for $5 a share, and 20 years later, they're getting $10 a share of dividends per year. Dividends do make a difference. Dividends are a great way to measure a company's success, particularly a slow-growing company. When a company raises its dividend every year, it raises the bar for its financial performance the years that follow. Few companies want to cut their dividends. Investors clobber the stock, figuring a dividend cut is a sign of worse things to come. So by raising a dividend 12 to 15% this year, the company is saying it expects earnings to be at least as good next year as they are now, and probably rising by at least the 12 to 15%. You can get a list of companies that have raised their dividends many years in a row from Moody's. There are some great names in this list. However, you can find warning signs of dividends as well.
A high yield isn't always a good thing. If a stock is 30 and it's paying a $3 dividend, you might say, wow, that's terrific, a 10% yield. But if the earnings are only $3.10 a share, then the company is essentially paying out all of its earnings in dividends. That's only 10 cents to expand or to invest in more efficient equipment. If this continues for a number of quarters or years, the company will have very little room for any errors or setbacks. Eventually, the company will probably cut back or totally suspend its dividend. The stock price is going to tumble with it. Be careful with high-yield stocks, particularly when they're paying out a very high percentage of their earnings. Any company's operations can hit an air pocket from time to time. You've got to make sure your company can survive tough times.
The balance sheet tells you about the company's financial structure, how much debt it has, how much cash it has, and how much equity its shareholders have. There's nothing scary about a balance sheet.
No story is complete without a check of the balance sheet. The basic concept of a balance sheet is that everything a company owns, its assets, are listed on one side. On the other side, you find everything a company owes, its liabilities. The difference between what it owns and what it owes is its equity, also called its net worth. Go ahead and explore this fictional balance sheet. Click any of the items on this balance sheet for an explanation of it. When you're ready to move on, click either the debt or cash buttons for a discussion of the two most important items on any balance sheet.
Does the company have a lot of cash on hand? That's great. A company with a lot of cash can buy more stock, make an acquisition, or pay off all its debt. All moves that shareholders love to see.
A company should have at least enough cash to pay off its short-term debt. If it doesn't, it could have to keep borrowing more and more. If you subtract cash from short-term debt and long-term debt, and the total is only 1/4 of net worth, the company has a decent balance sheet. However, if short-term debt and long-term debt combined, minus cash, equals or exceeds net worth, the company has a weak balance sheet. It's simple to recognize a strong balance sheet. No debt and lots of cash.
Suppose a company has $20 million in cash after subtracting all debt. If the company has 4 million shares outstanding, it has $5 of cash per share of stock. If you buy the company at $10 a share, you're paying only $5 for the company and you're getting $5 a share in cash. That's a really amazing price. In effect, that means your real price is $5. If this company has a very solid, predictable business, this extra cash is quite valuable. But if a company has lots of cash and they're losing money, you still have to evaluate how quickly will they run through all that cash. That's all you really have to know. It's not much, but you should know it. You can look it up in the stock shop. If you don't check your company's survivability, you're not only skimping on your research, you're gambling. That's not why you invest in the stock market. Check the debt. Most companies have some debt, but how much is too much?
Add up the company's long-term debt and total equity. That's a good approximation of the company's total capitalization, the money the company has available to grow its business in the future. Now compare the long-term debt to total capitalization.
If total debt equals half of the company's capitalization or more, beware. That's quite a bit of debt. To service that much debt, everything has to work right. Things don't always work just right.
If debt equals 20% of capitalization or less, that's better. That's fairly low debt. As usual, there is no rule without some exception. Debt in some industries, like banking, insurance, and financial services, routinely runs much higher than 20 to 50%. Know the industry and what is normal for it when you evaluate a balance sheet.
In many industries, such as retailing and restaurants, companies have leases. They have commitments on buildings to rent for a long period of time. Often, this form of debt will only appear in the footnotes. This is a very substantial form of debt. Look into the footnotes. See if you see capitalized lease obligations. Add this back. This is an important exercise.
5 or 10 years ago, investment professionals had a big edge. They got more research and information than small investors, and they got it sooner. But those days are long gone. Basic financial information is readily available from a dozen or more different sources. Investment pros aren't digesting all the good information and throwing just the scraps to the public anymore. Everyone has a seat at the table right now. Here are some places to get started. If a balance sheet provides a snapshot of a company's financial position, an income statement tells you how the company got there. Income statements tell you how much money the company made or lost from its operations over some period of time. The basic formula is simple. You are asking how things went over the period, usually a quarter or a year. Over that time, you add up all the money the company brought in from selling products or services, then subtract all of the money the company spent to create those products or deliver those services. What is left is the net income. Net income is also referred to as earnings or profits. I hope by now you've been convinced that your story should always include an explanation of how the company plans to improve its earnings or to sustain its growth rate over time. There are only two ways for a company to increase earnings. They can increase sales or reduce costs. Most companies work to do both of these things. The income statement can help you figure out if the company is succeeding. Click any of the items on this income statement for an explanation of it. Once you've explored the income statement, click on Increase Sales or Reduce Costs to explore those topics some more. If earnings equal revenues minus costs, then a valid way to raise earnings is to reduce costs. Reducing costs not only pushes up the earnings number, it makes a company more competitive. If two companies both produce competitive products of similar quality, then the one who can build it more cheaply has the advantage. They can choose to charge less for the product and sell more than their competitor, or can sell it for the same price and make much more money than their competitor. One way to measure cost reduction is to check out the costs listed on the income statement each quarter, but it's difficult to do so because what you really care about is how costs are changing relative to revenues. One way to measure this cost to revenues is the profit margin. This number is not shown on the income statement itself, but is calculated for you in the research section of the stock shop. To calculate the number for yourself, just divide the earnings before taxes by the net revenues. The higher the profit margin, the more money the company makes for each product it sells. Once we have the profit margin as a tool, we can evaluate how successful the company is being in reducing costs. Unless the company has raised prices significantly, if the profit margin goes up, then costs are going down relative to revenues. You can compare the profit margin of the company to the profit margin of a competitor, or to the average profit margin of the industry. When a company that's highly profitable already must depend on cost cutting to boost its profits even further, you have to be skeptical. If its profit margins are unusually high compared to the rest of the industry, there's a limit to how much additional profit it can squeeze out of the business by economizing. Ask yourself, is there a long road of margin cutting ahead, or are they already extremely efficient? Your goal is to feel as confident as possible with your story. How does the company plan to increase earnings? Sales growth is the single most important factor in growing earnings long term. So you must ask yourself how the company is going to make sales rise. The company can expand its customer base. Selling its existing products to new customers brings in new revenue. When evaluating this strategy, consider how far the company is from saturating the market for its products. If a company is already selling to 98% of its potential customers, there aren't a lot left to reach. The company can introduce new products into its existing customer base. This is the most difficult, but potentially the most rewarding strategy. If the product catches on, it can breathe new life into the company. Advantages like brand names and a good reputation come in very useful here. A company can also raise prices to increase revenues. That way, even if unit sales stay constant, revenues will still grow. Of course, the danger of raising prices is that the higher prices will drive customers to competitors, or encourage new competitors to enter the market. The details of a company's plan will vary by industry and by individual company. Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully or you'll get burned. Use your story to pick the right time to buy a stock. I promise you that the right time to buy a stock does not occur often. When I'm following a stock, buying opportunities present themselves once or twice a year, if I'm lucky. I look for times when the potential upside is high and the potential downside is reduced. Understanding that balance is a key to successful stock investing.
You have to understand, stock picking is a risk-reward trade-off. You have to know how much you're going to lose if you're wrong and how much you're going to make if you're right. The skill is to minimize your risk and maximize your reward. You can be wrong in this business. I've been wrong quite a bit. But you can be wrong and still make money, as long as your good stocks more than offset your mistakes. I figure if I can be right 6 times out of 10, that's a good batting average.
When I pick stocks, I think of risk as a measure of my confidence in the story I've built. When I feel that my story is optimistic, solid, and well-researched, then I've got a low-risk investment. If I'm not too sure about how the story will turn out, then the risk is considerably higher. Don't try to categorize risk by other measures, like small companies are riskier than large. In the late 1970s or the early 1980s, Walmart was a lower risk investment than IBM, because the Walmart story was nearly bulletproof. If a startup company sounds exciting, keep an eye on it. Perhaps a year or two later, it will be over the hump, the story will be solid, and there's a good time to consider investing. If you believe strongly in your company's story, then you shouldn't waste your time waiting for the ultimate buying opportunity. Investors who bought McDonald's in the 1970s or Home Depot in the 1980s were happy almost any time they bought the stock. Even with these great companies, during stock market corrections, the stock dipped and the story was solid, but if you held on for a reasonable amount of time, you were a very happy camper. Watch out for ridiculously high prices when a company is selling at several times its growth rate in earnings. Remember, that's what we talked about in the price earnings presentation. But in general, if a story is good, you probably want to own it. Later, if a buying opportunity comes along, if the stock falls well below its growth rate and the story hasn't changed, you can buy even more. Therefore, you can take advantage of market declines. Use the tools I've presented in this consultation to help make a judgment on your stock. If the story is sound, check the price. Use the PE ratio. Most importantly, rely on your edge. First to build your story, then to find the right times to add or reduce your position.
Focus on the company. What is it making? Where's its money coming from? What is the competition doing? Ignore all the background noise. Just keep checking that fundamental story. See if it's valid, see if it's getting better, see if it's getting worse. Know what category your stock is in and how those stocks behave. If your stock isn't behaving as you expect, then try and find out why. If the answer changes the story, then think again. Keep your story up to date. Don't check on it 3 times a day, but don't just ignore it either. And checking the price of the stock does not count. It's checking the fundamental story. Don't expect to make a ton of money overnight. The stock market does provide the highest return for long-term investments, but that's not a month or 2 months a year. If you need the money next winter, you don't have the tolerance to keep it tied up for the long term, and stocks may not be for you. Don't forget to use your edge. These are all kinds of things that you know about. Because of where you live, what you do, you have lots of edges. Use them. And finally, remember that stock picking isn't gambling, and it isn't for everyone. You have to be prepared to do some work. You have to be prepared for market declines. If you enjoy doing research, if you enjoy learning about companies, and you have the stomach for the ups and downs of the stock market, then investing can be a lot of fun. These principles of investing have worked well for me. I hope they can help you.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.
To start researching your stocks, just click on Research and remember that you can come back to consult Peter at any time. Welcome to Stock Shop, where you can learn to pick stocks, research them, and follow your favorites. The consultation part of the shop is where Peter Lynch explains how he thinks about stocks and how he makes his choices. These multimedia presentations describe some of the key concepts that will help you construct your portfolio. Just select the presentation of your choice from the list on the left and click the Start button to share Peter's thoughts and experiences. The research section is where you can create a list of companies that you want to research. You can download current data on any number of stocks and get Peter's guidance on what to look for next. And you can start to compile your own story for every stock you follow. Just select a stock and click on Details to view the fundamental data about your stock. And finally, at the bottom of the screen are all the tools you'll need to explore and keep track of your discoveries in the stock shop. And now you can either select one of Peter's personal presentations, or if you want to get to work, go straight to research.
You can't just go out and buy a stock and hope it goes up. You have to have a reason why you think a stock will go up. You should be able to tell those reasons to someone else in just a few minutes. People who love stocks don't talk about sports. They don't talk about their dog. They talk about stories. A story is what's happening inside a company and signs that point to what's likely to happen in the future.
You'll be able to put it down in 2 paragraphs. It could be something like earnings are turning around, a new product, somebody's gone out of business that was competing with them, they've just discovered oil, they've got new management, their balance sheet's getting better, they're getting rid of a losing division. There's lots of different elements, but that's what a story is, and that's what you rely on.
A good story is one that you could tell a 5th grader, and he or she would understand. The more complicated the story, the more likely it is to fall apart. You just need one good, simple story to buy a stock, and then follow that story.
Read through the story that I wrote for Toys R Us back in 1978. You didn't need a degree from business school to realize that this company had a great formula and had lots of room to grow. The thousands of people who shopped there knew the store was great. I did the rest of the research I needed to fill in the story and bought the stock. Building stories like this one is how I decide what companies to own and which ones to stay away from. Remember that stories unfold over time. Companies are never stagnant, so you have to stay tuned and sometimes make adjustments. It's just like playing 7-card stud poker, or perhaps 27-card stud poker. At the beginning of the game, you only know some of the cards and must place your bet accordingly. But as each new card is revealed, the game changes. You're forced to alter your betting strategy, perhaps even drop out of the game altogether. In the rest of this consultation, I'll show you how you can build stories for companies and invest more prudently in their stock. This consultation is divided into 3 sections. The assessment section helps you decide whether stocks are the right investment for you. Stock picking is not for everyone. These presentations will help you assess yourself. In the story creation area, I'll cover the basic concepts you need to create your story. You'll learn how to approach a company's story and why you have some advantages over even the most dedicated investment professionals. In the last section, we get down to brass tacks, talking about the actual elements and numbers you'll need to include in your story. Use the Start and Next Presentation buttons to move through the presentations in order, or explore on your own using the list on the left. When you're done, you'll know how to build a story, how to monitor the key elements of the story, and how to use that story to improve your understanding of when and when not to invest in a company's stock. You may find that stock picking is not right for you, at least not until you feel more comfortable with the risks of the market and the volatility of stocks. Even if this is the case, the Stock Shop can still help you become more comfortable with the stock market and researching companies. Use the Stock Shop to follow companies in a paper portfolio, a list of stocks you buy and sell only on paper. You develop your stock picking skills without taking any of the risks. Before long, you may be ready to start investing your real hard-earned cash. In the meantime, if you like to invest in stocks, your best option may be an equity mutual fund. If you want to put some of your money in the stock market, you don't have the time, you're not willing to do the effort, you don't have the stomach to do the research, equity mutual funds are a great answer. Investing in mutual funds is also a way of making sure your investments are diversified. Mutual funds, by law, must invest in at least 20 stocks at a time, though most funds invest in far more than that. As a mutual fund investor, you are protected from the danger of 1 or 2 stocks dropping sharply in price. At most, they would only represent 5 or 10% of the fund. This would cushion the decline. Remember, the mutual funds are like any other investment. They carry real risks of losing your money. And even though they can be purchased through many banks, they are not insured by the government. Since they are made up of individual stocks, equity mutual funds are also volatile. You must do some research to evaluate and choose a mutual fund that will meet your temperament and your investment objectives.
Cheers. So welcome everyone to this seminar hosted by the Institute of Trading and Portfolio Management. We're lucky enough to have Anton Kriel with us here today, Managing Director of the company, who's flown in from Singapore especially to give this presentation. And it wasn't long ago that I was sitting there in your position listening to one of Anton's presentations back in 2012. With little or no trading knowledge myself and just looking for somewhere to learn. And Anton's certainly been a great mentor to me over the years, as I'm sure he will be with you guys going forward. So that being said, it's my pleasure to introduce our speaker for the evening, Mr. Anton Kriel.
Hi guys, welcome. So we're short on time today. It's a huge presentation. We're not going to be able to take questions during the presentation, but we're going to be in the pub later. You can see some of the mentors here as well from the Institute, so you can ask a lot of questions there later. We're going to aim to get finished by around 9:15. So without further ado, let's get on with it. So here's the schedule for today. First thing we're going to look at, we've called it the other side of the fence, professional trading knowledge that professionals do not want retail traders to know. Some of the things you're going to see today are very harsh and aggressive home truths. And you might not like some of the things you see, but it's honest, it's truthful, and you've just got to deal with it. There's things that professional traders don't want you guys to know, so they are at an informational advantage in the financial markets versus you guys. We're going to look at some of the market participants, the broker, the educator, and the retail trader, how your side of the industry works. So basically not the professional side, and we're going to look at the differences. We're going to look at something called the inversion narrative, so why the vast majority of retail traders in the UK, Europe, and Asia lose money, and why the vast majority of retail traders in the US lose money. There's some subtle differences. And we're also going to look at charlatan educators, fake traders, how these guys create a story about themselves and suck naive retail traders into believing what they want you to believe. So I'm going to show you how to spot these guys. And then we're going to look at how you actually go about getting consistent profitability as a retail trader. So let's get started. First things first, why the hell do we care? How many people here have actually traded? Who's got a brokerage account? Okay, so that's quite a lot, 40% of the room. Who hasn't? Who's never ever tried it? Okay, so the minority of the room has never actually pushed the button, okay? So that's quite interesting. So, why do we care? Well, people have tried, and the vast majority lose money. But if you haven't tried, if you haven't done anything in the retail trading world, whether you like it or not, you are in the finance industry. If you participate, if you've got a mortgage, you own a business, you own a home, you've got a bank account, a credit card, a debit card, whatever. You are in the finance industry whether you like it or not. You are a participant in the economy. But there's another reason as well. Pensions. The pensions infrastructure that was essentially set up in the 70s has failed the Western world. What's the pensions question? The pensions question is, can I get income in retirement? Can I live my life in retirement? And the pension solution is to provide that income, but no one can retire. What's the average pension number in the United Kingdom? Average pension balance. It's about £30,000. In the US, in dollar terms, it's about $60,000, $70,000. In Europe, it's about the equivalent of the UK, about £30,000. So about 40,000 euros. Asia, there's varying degrees. So for example, Singapore have the highest pension values in the world. The average pension value is $330,000. But there's reasons for that, which is another lecture. But essentially, in the Western world, pensions have failed. So what's happening? Boomers and Gen Xers are desperate because they know they can't retire. So people are always looking for a solution. And this is why people come to seminars like this. But you've got to be warned. You're not the only people that have realized this. Everyone's realized it, and also an entire industry has been built around a narrative to provide you with solutions to this problem. Essentially catered to the desperate middle-class fool. Now, this idea of learning how to do everything yourself, it's a noble idea, but it's fraught with dangers. Because there's a lot of bad people in the world who want to cater to the middle-class fool, and those bad people do things that are not good for you. They're only good for them. And our continuous campaign at the Institute is to basically first show you guys how it actually works. Show you basically how the landscape, how the industry works, so you can figure out how not to lose money, how not to fall into all the traps, how to make all the classic errors as a trader or an investor. And then the second thing we do is actually teach you how to then go and make money. So the first thing you have to do as a retail person in this industry is to essentially make sure you have no downside. Don't do all the stupid things. Learn how basically to avoid all the mistakes. Then it's about learning how to make money over time. And we've been providing the information in this seminar, for example, for close to 5 years in closed seminars. So it's never been publicly available. And this is why we're filming today, because we're now going to stick this on YouTube. And the whole world's going to see it. And this is why you have to, if you've heard of this phrase, be woke. Okay? What you're going to get taught today, pretty much every retail trader will never, ever figure it out. And it's pretty simple, straightforward stuff. But most retail traders, the vast majority, will never figure it out. And even if they do, they've been on a journey where they've lost so much money to figure it out, it's now pointless. So here, we're literally saving you a lifetime of losses. Or if you figure it out after 10 years, a decade of losses. So this is really useful information. First thing you have to do when entering any industry whatsoever, if you were going to set up a new business, the first thing you would do is do an industry appraisal. Who are the winners? Who are the losers? How's the industry set up? What parameters can I operate in? How do I be successful? What mistakes do I need to avoid? If you were going into any industry, you would do that as a smart business person. Why would you not do it in trading? It's the first thing you have to do. And there's been some major trends in the last 30 years that really affect retail. And they're very important. They have significant consequences. The first one is how the market's set up. Who owns the exchanges? The exchanges is where all the business is cleared. Every time you press the button, the order goes down a pipe, through a broker, through an investment bank, to the exchange. Who owns all the exchanges? Well, there we have it. Intercontinental Exchange, ICE, own NYSE and Euronext. That's the majority of business in the market. The Chicago Mercantile Exchange owns the Chicago Board of Trade, NYMEX, and COMEX. So basically, we have a monopoly / duopoly. What does that mean? What do we think it means? Who does economics here? Monopolies. Do we like them? What's the negative of monopolies? Potentially. Pricing power and control. So we'll come back to that later. But the exchanges are now basically owned by a couple of companies. And by having a monopoly, they can control the market if they want to. How the market is set up, how the players must operate. Who they incentivize. Parameters like this. We'll come on to it later again. Second, technology. Obviously, technology's played a major role in the last 30 years. First things first, infrastructure. Massively increased retail trader participation. 30 years ago, you'd be on the telephone, calling a broker and just accepting the price on the phone, whatever you got. What have you got now? Well, internet penetration, internet capability, speeds, very low barriers to entry. Everyone can trade from their bedroom or their phone. Very easy access. Is that necessarily a good thing? If you have access, does it mean you're good? Of course not.